Hello there, and welcome. I'm so glad you found your way here tonight. Before we begin, take a moment to get comfortable. Adjust your pillow, let your body settle into whatever position feels right. There's no rush. We have all the time in the world. Where in the world are you watching from? A quiet bedroom as the night deepens, a cozy corner where the weight of the day is finally lifting. Wherever you are, you're exactly where you need to be. Tonight we're going to explore one of the most elegant principles in all of finance, a simple rule that has protected wealth for centuries, that ancient merchants understood instinctively, and that modern mathematics later proved with beautiful precision. We're going to discover why the wisest investors, from medieval traders to modern billionaires, all follow the same fundamental insight. Never put all your eggs in one basket. It's called diversification, and by the time our journey ends, you'll understand why it's been called the only free lunch in finance. But don't worry, this isn't going to be a frantic lesson in portfolio construction or an anxiety-inducing warning about financial risk. Instead, we'll move slowly and peacefully through centuries of human wisdom, through elegant mathematical discoveries, through stories of wealth preserved and wealth lost, all at a pace that invites you to drift, to relax, to let understanding wash over you like a gentle tide. If you enjoy these calm explorations of financial wisdom, a like and subscribe really helps reach others seeking the same peaceful way to end their day. And to those already subscribed, thank you for being part of this community of thoughtful listeners. So settle in, let your shoulders drop away from your ears, take a slow breath, in through your nose, out through your mouth, and let's begin our gentle drift through the timeless wisdom of balance, of spreading risk, of the profound simplicity that protects everything from ancient merchant fortunes to modern retirement accounts. There's nowhere you need to be, no decisions to make tonight. Just listen and let the story unfold like a long, quiet conversation between old friends. If you drift away, that's perfectly fine. That's what we're here for. Let's begin with a story that's thousands of years old. Long before stock markets existed, before banks as we know them, before the entire apparatus of modern finance was even imagined, human beings understood something fundamental about risk. They understood it not through mathematics or economic theory, but through hard experience, through observation, through the accumulated wisdom of generations who had learned costly lessons about putting too much faith in any single thing. Picture a merchant in ancient times, perhaps in Babylon or Jerusalem, perhaps along the Silk Road, or in a Mediterranean port city. This merchant has worked for years, accumulated wealth through careful trading, and now faces a decision. He has goods to send to a distant market. The journey is dangerous, bandits on the road, storms at sea, political upheaval in foreign lands. If the cargo arrives safely, the profit will be substantial. But if it's lost, everything is lost. What does the merchant do? The Talmud, that ancient compilation of Jewish wisdom and law, offers guidance that would sound remarkably familiar to any modern financial advisor. It recommends dividing one's wealth into 3 parts: a third in land, a third in business, and a third held in reserve. Not everything in one place, not all resources committed to a single venture. Instead, spread across different forms, different risks, different possibilities. This wasn't just spiritual advice. This was practical wisdom born from watching fortunes rise and fall, from seeing what happened to those who concentrated everything in one place versus those who spread their resources across multiple holdings. The principle was clear. Diversification protects against ruin. Medieval merchants understood this deeply. When cargo ships sailed from Venice or Genoa, or the ports of the Hanseatic League, wealthy investors rarely funded a single ship. Instead, they would take shares in multiple vessels, each sailing to different destinations at different times, carrying different goods. One ship might sail to Alexandria with wool and return with spices. Another might venture to Flanders with wine and return with cloth. A third might risk the journey to the Levant with metal goods and return with silk. Why spread investments across multiple ships? because the sea was treacherous and unpredictable. Pirates prowled the Mediterranean. Storms could destroy even the sturdiest vessel. Political conflicts could close ports without warning. If you placed all your wealth on a single ship and that ship went down, you were ruined. But if you owned shares in 10 ships and one was lost, you still had 9. The loss hurt, yes, but it didn't destroy you. You could absorb it, recover, continue. This strategy had a name in Italian, colleganza. In Barcelona, they called it commenda. The specific terms varied by region and era, but the principle remained constant. Spread the risk, accept smaller individual gains in exchange for protection against catastrophic loss. Understand that survival matters more than maximum profit on any single venture. Think about how elegant this is. These merchants didn't have spreadsheets or statistical models. They couldn't calculate standard deviations or draw efficient frontiers. But they understood correlation, they just didn't call it that. They knew that the fate of a ship sailing to Egypt was largely independent of the fate of a ship sailing to England. Bad weather in one region didn't mean bad weather in another. Political turmoil in one port didn't necessarily affect another. By spreading their investments across vessels with uncorrelated risks, they created portfolios that were more stable, more survivable than any single concentrated bet. Shakespeare, centuries later, would reference this wisdom in The Merchant of Venice. Antonio, the merchant of the title, reassures his worried friends about his financial state. His wealth, he explains, isn't tied to a single ship or even a single voyage. My ventures are not in one bottom trusted, nor to one place, he says. His fortunes are scattered across multiple ships, multiple seas, multiple possibilities. This diversification gives him confidence, allows him to sleep at night despite the inherent risks of maritime trade. Of course, the play's irony is that Antonio isn't quite as diversified as he thinks, and complications ensue. But the principle Shakespeare invokes would have been immediately understood by his audience. Putting all your eggs in one basket is foolish. Spreading them across multiple baskets is wisdom. Agricultural societies practiced their own forms of diversification. Farmers learned not to plant a single crop, but to cultivate variety. If the wheat failed due to early frost, perhaps the barley would survive. If disease struck the apple trees, the pear trees might be spared. Crop rotation wasn't just about soil health. It was about survival, about ensuring that a single catastrophe didn't mean starvation. In medieval Europe, peasants who could manage it would have strips of land in different fields, in different locations. This wasn't inefficiency or poor planning. This was deliberate diversification. A flood might destroy the low-lying fields but spare the hillside plots. A hailstorm might devastate one area but leave another untouched. By spreading their small holdings across geography, peasants increased their chances of having something to harvest, something to eat, something to sell or barter. Even the structure of medieval towns and guilds reflected diversification thinking. A family might have one son apprenticed as a baker, another learning carpentry, a third preparing for the clergy. This wasn't just about covering all bases socially, it was economic insurance. If the bread business suffered, perhaps the carpenter would thrive. If both struggled, a son in the church at least had security and could potentially support family members. The principle appears across cultures and centuries because it reflects something fundamental about human vulnerability and wisdom. We are small creatures in an uncertain world. Catastrophe can strike from unexpected directions. The only reliable protection is not to be too heavily invested in any single outcome, any single strategy, any single possibility. Chinese proverbs speak of not putting all your eggs in one basket. African wisdom traditions teach the value of planting in multiple plots. Everywhere humans have accumulated wealth and tried to preserve it across generations, they've arrived at the same conclusion. Concentration is dangerous. Distribution is wise. What's beautiful about this ancient understanding is that it wasn't based on greed or even profit maximization. It was based on something more profound, the desire to survive, to protect what you'd built, to ensure that a single stroke of bad fortune didn't undo years of effort. Diversification, at its root, is conservative in the truest sense. It conserves, it preserves, it protects. The merchant who diversified might not have made quite as much when one voyage proved spectacularly profitable. If he had put everything on that single ship, he'd have multiplied his wealth many times over. But he also wouldn't have been destroyed when another voyage failed catastrophically. He traded the possibility of maximum gain for the assurance of survivability. He chose steady accumulation over spectacular risk. He slept better at night. Think about the deep wisdom in this. Our ancestors understood that life is long and fortune is fickle. The goal isn't to win big once and hope it lasts forever. The goal is to keep playing, to survive setbacks, to be positioned to take advantage of the next opportunity. Diversification keeps you in the game. It protects you from the hubris of thinking you can predict which ship will sink and which will sail safely home. As the centuries passed and commerce grew more sophisticated, the principle of diversification became more formalized but no less essential. By the time we reached the 17th century and the dawn of modern financial markets, diversification was already ancient wisdom, tested across countless lifetimes, proven through the survival of families and fortunes that understood it, versus the ruin of those who didn't. But understanding something intuitively and proving it mathematically are different things. For thousands of years, people knew diversification worked. They just couldn't explain precisely why, couldn't measure exactly how much protection it provided, couldn't optimize the balance between risk and return with mathematical precision. That would require a revolution in thinking, a leap from intuition to equation, from merchant wisdom to scientific theory. And that revolution, when it came, would arrive from an unlikely source. A graduate student in Chicago in the early 1950s, asking questions that seemed almost too simple, too obvious. I'm to be the foundation of a Nobel Prize. But we'll come to that. For now, let's let this ancient wisdom settle. Picture those merchant ships sailing across the Mediterranean, each carrying a piece of someone's fortune, none carrying all of it. Picture the farmer's diverse fields, the artisan's multiple apprentices, the careful spreading of risk that allowed civilizations to flourish despite uncertainty. The wisdom was always there, passed down through generations, embedded in proverbs and practices. It just needed someone to prove why it worked, to reveal the mathematical elegance underlying the intuition. And in 1952 in Chicago, that proof was about to emerge. In March of 1952, a 25-year-old graduate student named Harry Markowitz submitted his doctoral dissertation to the University of Chicago. The title was technical and unremarkable, Portfolio Selection. The content, however, would eventually revolutionize finance, earn Markowitz a Nobel Prize in economics, and transform how everyone from individual investors to massive pension funds thought about building and managing investments. What Markowitz did was both simple and profound. He took something merchants had understood for millennia, that spreading investments reduces risk, and proved it mathematically. He showed not just that diversification worked, but precisely how it worked, and more importantly, why combining certain investments together could create portfolios that were less risky than any individual investment within them. This wasn't obvious. In fact, it seemed almost magical. Let's slow down and really think about what Markowitz discovered, because it's genuinely beautiful, and understanding it doesn't require complex mathematics, just patience and imagination. Imagine you're deciding between two investments. The first is a company that makes umbrellas. The second is a company that makes sunglasses. Now, think about how these businesses perform in different weather. When it rains frequently, umbrella sales boom and the umbrella company thrives. But in those same rainy conditions, sunglasses sales slump and that company struggles. Conversely, during long sunny periods, the sunglasses company prospers while the umbrella company barely gets by. If you look at each company individually, both are quite risky. Their fortunes swing wildly based on weather patterns. The umbrella company might earn huge profits one year and barely break even the next. The sunglasses company faces the same volatility, just in the opposite direction. Now here's where it gets interesting. Where Markowitz's insight becomes clear. What happens if you own both companies? If you invest half your money in umbrellas and half in sunglasses, when it rains, your umbrella investment gains value while your sunglasses investment loses some. When it's sunny, the reverse happens. But overall, across different weather conditions, your combined portfolio is much more stable than either investment alone. You've reduced your risk without necessarily reducing your expected return. You haven't eliminated uncertainty. You can't control the weather, but you've protected yourself from the worst outcomes of any single weather pattern. This is the essence of what Markowitz formalized. The risk of a portfolio isn't just the average risk of its individual parts. It depends on how those parts move together, what he called their correlation. Correlation is a measure, ranging from -1 to +1, of how two things move in relation to each other. If two investments have a correlation of +1, they move in perfect lockstep. When one goes up, the other goes up by a proportional amount. When one falls, so does the other. Owning both provides no diversification benefit because they are essentially the same risk expressed twice. If two investments have a correlation of -1, they move in perfect opposition. When one rises, the other falls by a proportional amount. This is like our umbrella and sunglasses companies. Owning both provides maximum diversification benefit because they balance each other perfectly. Most real investments have correlation somewhere in between, often slightly positive because most businesses are affected by broad economic conditions. But as long as the correlation isn't perfect, combining investments reduces overall portfolio volatility. Here's where Markowitz's mathematics became powerful. He developed equations that could precisely calculate the expected risk and return of any combination of investments, given their individual characteristics and their correlations with each other. This allowed investors, for the first time, to scientifically construct portfolios that optimize the trade-off between risk and return. He introduced the concept of the _2_, the set of portfolios that provide the maximum expected return for a given level of risk, or equivalently, the minimum risk for a given level of expected return. Any portfolio on the efficient frontier is optimal in the sense that you can't improve it without either accepting more risk or accepting lower expected returns. This was revolutionary thinking. Before Markowitz, investors generally focused on individual securities. They tried to pick the best stocks, the bonds with the highest yields, the most promising opportunities. They thought about portfolio construction, if they thought about it at all, mainly in terms of how much to invest in each opportunity. Markowitz showed that this was looking at the problem backward. The question wasn't just which investments are best, but rather which combinations of investments are best. An investment that looks mediocre on its own might be valuable in a portfolio if it has low or negative correlation with other holdings. Conversely, a fantastic investment might add less value to a portfolio if it's highly correlated with what you already own. Let's make this concrete with numbers, though we'll keep them simple and gentle. Imagine investment A has an expected return of 10% per year, but with high volatility. Some years it might return 30%, other years it might lose 15%. Investment B also has an expected return of 10% with similar volatility. If you look at them individually, they seem equivalent. But now consider their correlation. If A and B have a correlation of +1, they move together perfectly. Then owning both doesn't reduce your risk at all. Your combined portfolio will still swing wildly between 30% gains and 15% losses, just like each individual investment. But if A and B have a correlation of 0, They move independently of each other, then combining them reduces your volatility substantially. When A has a bad year, B might have a good year, and vice versa. Your portfolio still has an expected return of 10%, but the year-to-year swings are smaller. You've reduced risk without reducing expected return. And if A and B have a negative correlation, they tend to move in opposite directions. The volatility reduction is even greater. You still expect to earn 10% on average, but the ride is much smoother. This is what economists mean when they call diversification, quote, 5. You're getting something, reduced risk, without giving up anything, expected return. You're improving your situation without any apparent cost. Of course, there are practical complications. Finding investments with truly negative correlations isn't easy. Transaction costs and taxes eat into returns. The future might not resemble the past, so historical correlations might not hold. But the fundamental principle remains. Thoughtful diversification, based on understanding how investments move together, can improve risk-adjusted returns. Markowitz's work sat relatively unnoticed for years. His dissertation was published in the Journal of Finance in 1952, but it was mathematically complex and challenged conventional thinking. The investment world, still largely dominated by stock picking and individual security analysis, wasn't ready to embrace portfolio-level thinking. But gradually, especially as computers made the calculations more practical, Markowitz's insights spread. By the 1970s and 80s, institutional investors were using modern portfolio theory to construct diversified portfolios. Pension funds, endowments, insurance companies. They all began thinking in terms of asset allocation, correlation, and efficient frontiers. In 1990, Markowitz shared the Nobel Prize in Economics for his portfolio theory work. The prize committee recognized that he had fundamentally changed how we understand investment and risk. He had taken ancient merchant wisdom, don't put all your eggs in one basket, and revealed the mathematical elegance underneath. What's beautiful about Markowitz's contribution is that it doesn't contradict or replace intuitive wisdom. It validates and extends it. The merchant who diversified across multiple ships was doing exactly what modern portfolio theory recommends, combining investments with imperfectly correlated outcomes to reduce overall risk. Markowitz just proved why this worked and showed how to do it optimally. There's something deeply satisfying about this progression from intuition to proof. For thousands of years, humans knew diversification was wise without fully understanding why. They couldn't calculate correlations or draw efficient frontiers, but they understood, bone deep, that spreading risk was prudent. Markowitz honored that wisdom by revealing its mathematical foundation. The practical implications were enormous. Investors could now construct portfolios scientifically, balancing risk and return based on measurable factors rather than gut feeling. They could quantify the benefits of adding different asset classes to their portfolios. They could understand precisely how much risk reduction came from owning 20 stocks versus 10 versus 50. But perhaps most importantly, Markowitz's work shifted focus from individual securities to portfolios, from pieces to the whole. It wasn't enough to find good investments. You had to find investments that worked well together, that complemented each other, that created a stronger portfolio through their combination than any of them could achieve alone. This is the mathematical expression of an ancient truth. We're stronger together than alone, whether we're talking about investments in a portfolio or people in a community. Diversification isn't just about reducing risk. It's about recognizing that wholes can be greater than the sum of their parts, that careful combination creates emergent properties that don't exist in isolation. As you drift towards sleep tonight, let this thought rest gently in your mind. There is profound mathematical elegance in the simple wisdom of spreading risk, of not putting all your eggs in one basket, of building portfolios that balance and support themselves through the natural variation in how different assets move. What ancient merchants knew through experience, modern mathematics prove through equations. Both arrive at the same truth. Diversification protects, preserves, and sustains. And that truth, whether expressed in Talmudic wisdom or elegant mathematics, remains as relevant today as it was thousands of years ago, as relevant for managing a retirement account as it was for loading cargo ships in medieval Venice. Let that settle. Let the beauty of the principle wash over you. We've moved from ancient ports to modern equations, from intuition to proof, and found that wisdom transcends time. There's more to explore, more to understand about how diversification works in practice. But for now, rest in this knowledge. The simple rule that protects millionaires, that protects anyone who follows it, is the same rule that protected merchants sailing the Mediterranean centuries ago. Spread your risk. Embrace balance. Trust in the mathematics of combination. Let's continue our gentle journey through the landscape of diversification, moving now from the mathematical foundation to the practical question that every investor must answer. Diversify across what exactly? Because understanding that diversification reduces risk is one thing. Knowing how to actually diversify, what categories of investments to spread across, how they behave differently, why combining them creates protection, that's where theory meets the real world of building wealth and preserving it across the years. Take a slow breath. Let your mind settle. We're going to explore the major asset classes, those broad categories of investments that form the building blocks of diversified portfolios. We'll move slowly through each one, understanding not just what they are, but how they move, how they respond to different economic conditions, how they complement and balance each other across the cycles of boom and recession, inflation, deflation, growth and stagnation. The most familiar asset class, the one most people think of first when they hear the word investment, is stocks. When you buy stock, you're purchasing a small piece of ownership in a company. You become a shareholder, a part owner, entitled to a portion of the company's profits and bearing a portion of its risks. Stocks represent the growth engine of most portfolios. Over long periods, decades, not months or years, stocks have historically provided returns higher than most other asset classes. This makes sense when you think about it. Companies create value. They innovate, produce goods and services people want, grow their sales and profits. As shareholders, stock owners participate in this value creation. But this growth potential comes with volatility. Stock prices swing, sometimes dramatically. In a single year, the stock market might rise 30% or fall 20%. In extreme cases like the crash of 1929 or the financial crisis of 2008, stocks can fall 50% or more. This volatility, this day-to-day and year-to-year unpredictability, is the price you pay for long-term growth potential. Different types of stocks behave differently. Large company stocks, the Apples and Microsofts and Exxons of the world, tend to be somewhat more stable than small company stocks, though they still fluctuate. Small company stocks are more volatile but historically have provided higher returns over very long periods. International stocks add another dimension, exposing you to economic growth in other countries, but also to currency fluctuations and different political and economic risks. Now let's consider bonds, which are fundamentally different from stocks in both structure and behavior. When you buy a bond, you're not buying ownership. You're making a loan. The bond issuer, whether a government, a corporation, or some other entity, borrows money from you and promises to pay it back with interest. Bonds provide income through regular interest payments. They're generally less volatile than stocks. If you buy a high-quality government bond and hold it to maturity, you know with reasonable certainty what you'll receive and when you'll receive it. This predictability is valuable, especially for people who need steady income or who can't tolerate the wild swings of the stock market. But bonds have their own risks. Interest rate risk is the primary one. When interest rates rise, existing bonds lose value because newly issued bonds offer higher rates, making older bonds less attractive. Inflation risk matters too. If inflation runs higher than the interest rate your bond pays, you're losing purchasing power even as you collect interest payments. Here's where the magic of diversification between stocks and bonds becomes apparent. Stocks and bonds often move in opposite directions, especially during times of stress. When economic growth slows or recession threatens, stocks typically fall as corporate profits decline. But bonds often rise during these same periods because central banks lower interest rates to stimulate the economy, which increases the value of existing bonds. Think about the year 2008. During the financial crisis, stocks fell dramatically. The US stock market lost about 37% that year. It was frightening, devastating to anyone whose wealth was entirely in stocks. But high-quality government bonds rose about 5% that same year. Investors holding both stocks and bonds experienced losses, yes, but far smaller losses than those holding only stocks. The bonds cushioned the fall, providing stability when stocks were in freefall. The reverse can happen too. During periods of strong economic growth and rising inflation, stocks often thrive while bonds struggle. The 1970s demonstrated this pattern. Inflation ran high, devastating bond returns as interest rates climbed. But stocks, while volatile, at least had the potential to keep up with inflation as companies raised prices. This negative correlation, stocks doing well when bonds struggle, bonds doing well when stocks struggle, is what makes the combination so powerful. A portfolio of 60% stocks and 40% bonds, the traditional balanced portfolio recommended for decades, benefits from both the growth potential of stocks and the stability of bonds. The bonds smooth the ride, reducing volatility. The stocks drive long-term growth. Of course, the correlation between stocks and bonds isn't always negative. Sometimes they move together. The relationship changes based on what's driving markets at any given time. But over long periods, and especially during crises, bonds have tended to provide ballast when stock markets sink. Real estate represents another major asset class with its own distinctive characteristics. When we talk about real estate as an investment, we might mean direct ownership, buying properties to rent or sell, or indirect ownership through vehicles like real estate investment trusts, known as REITs, which allow you to own shares in portfolios of properties. Real estate has several attractive features. It provides income through rents. It tends to appreciate over time, though not in a straight line. It offers some protection against inflation, because property values and rents generally rise along with the overall price level, and it has relatively low correlation with stocks and bonds, meaning real estate often zigs when other assets zag. The financial crisis of 2008 reminds us that real estate isn't immune to catastrophic losses. Housing prices fell dramatically, wiping out trillions of dollars in homeowner equity. REITs plummeted along with the broader market. But over longer periods, real estate has provided diversification benefits, offering a different return pattern than stocks or bonds. Real estate also has practical considerations that make it different from paper assets. Properties require management, maintenance, property taxes, insurance. They're illiquid. You can't sell a building as easily as you can sell a stock. Location matters enormously. Real estate is local in a way that stocks aren't. But for those willing to accept these complications, real estate adds another layer of diversification. A portfolio containing stocks, bonds, and real estate is generally more stable than one containing only stocks and bonds. Each asset class contributes different characteristics, different strengths, different protections against different economic scenarios. Commodities represent yet another asset class, though one that most individual investors access only indirectly, through commodity funds or companies that produce commodities. Commodities are physical goods: oil, gold, wheat, copper, lumber, coffee. Their prices are determined by supply and demand, by weather and geopolitics, by industrial activity and consumer preferences. Commodities behave very differently from stocks and bonds. They don't generate income or dividends. They don't grow or innovate. You're simply betting that the price will rise or fall based on changing conditions. Gold might increase in value during times of fear or inflation. Oil might spike during geopolitical tensions or fall during economic slowdowns. Agricultural commodities depend on harvest conditions and global food demand. The value of commodities in a portfolio comes primarily from their low or negative correlation with traditional assets and their tendency to perform well during inflationary periods. The 1970s again provide the classic example. While stocks and bonds both struggled with high inflation, commodities, particularly oil and gold, soared. An investor holding some commodity exposure would have been far better protected than one holding only traditional assets. Gold deserves special mention because of its unique role in financial history and psychology. For thousands of years, gold has been viewed as a store of value, a safe haven during times of crisis. When paper currencies falter, when governments prove unreliable, when financial systems seem fragile, people turn to gold. Whether this makes rational economic sense is debatable, but the behavior is real and remarkably consistent across cultures and centuries. Gold provides no income. It doesn't grow or produce anything. Its value is entirely based on what others will pay for it. Yet a small allocation to gold in a portfolio has historically reduced volatility and provided insurance against extreme outcomes. During the 2008 crisis, gold held its value better than stocks. During the 1970s inflation, gold multiplied many times over. Cash and cash equivalents, money market funds, short-term treasury bills, savings accounts represent the most conservative, most liquid part of a portfolio. Cash earns minimal returns, often barely keeping pace with inflation, or even losing purchasing power in real terms. But cash provides certainty, immediate availability, and a foundation of stability that allows you to take risks elsewhere. The role of cash in a diversified portfolio isn't to generate returns. It's to provide flexibility, to be available for opportunities or emergencies, to allow you to hold other riskier assets without being forced to sell them at inopportune times. Cash is the shock absorber that lets you ride out market volatility without panic selling. During the 2008 crisis, investors who held cash reserves could take advantage of the extraordinary opportunities that appeared as stocks fell to bargain levels. Those without cash reserves were often forced to sell at the worst possible time to meet expenses or margin calls. Cash may not be exciting, but its value in preserving options and reducing forced errors shouldn't be underestimated. Now let's think about how these different asset classes work together across economic cycles. The economy moves through phases: expansion, peak, contraction, trough, then expansion again. Different assets perform best during different phases. During economic expansion, when businesses are growing and consumers are spending, stocks typically thrive. Corporate profits rise, employment increases, confidence builds. This is when stocks deliver those attractive long-term returns that draw investors to them. During peaks and early contraction, when the economy starts to slow and central banks begin cutting interest rates, bonds often perform well. As interest rates fall, existing bonds with higher rates become more valuable. The stock market might be struggling with weakening economic data, but bondholders are benefiting from falling rates. During deep recessions or deflationary periods, our high-quality government bonds and cash provide the most protection. Stocks fall as corporate earnings collapse. Real estate values decline. But the safest bonds hold value or even appreciate as investors flee to quality. During inflationary periods, when the general price level is rising rapidly, commodities and real estate tend to outperform. Stocks can survive inflation if companies can pass costs on to customers. But bonds suffer as inflation erodes the purchasing power of their fixed payments. Commodities, being physical goods, rise in price along with inflation. Real estate, being a tangible asset with rental income that can adjust upward, also tends to keep pace. The beautiful thing about holding all these asset classes together is that you're protected no matter which economic environment emerges. You won't have maximum performance in any single scenario. During a roaring bull market, you'll wish you'd owned only stocks. During a deflationary collapse, you'll wish you'd owned only high-quality bonds. But across all scenarios, across decades of unpredictable economic cycles, a diversified portfolio weathers the changes, participates in growth when it comes, and protects capital when storms arrive. Geographic diversification adds another crucial dimension. Don't invest only in your home country. The United States might seem like the natural place for American investors to focus, but the US represents only about half of the global economy and less than half of the global stock market. Europe, Japan, emerging markets in Asia and Latin America all offer opportunities and diversification benefits. International investing brings its own considerations. Currency fluctuations matter. Political and economic stability varies. Different countries are at different stages of development. Accounting standards and corporate governance differ. But these complications also mean that international markets don't move in perfect lockstep with US markets. When the US market struggles, international markets might hold up better, or vice versa. The Asian financial crisis of 1997 devastated markets in Thailand, Indonesia, South Korea, and surrounding countries. Investors concentrated in those markets suffered terribly, but investors with globally diversified portfolios experienced only modest declines because their US and European holdings cushioned the blow. Conversely, during the 2008 financial crisis that began in the United States, investors with international exposure had some protection as certain international markets, particularly in Asia, recovered more quickly than US markets. Currency diversification matters too. By holding assets denominated in different currencies, you protect against the decline of any single currency. If the dollar weakens, international investments become more valuable when converted back to dollars. If the dollar strengthens, US investments look better. Holding both provides balance. The traditional balanced portfolio, that's 60% stocks, 40% bonds allocation reflects these diversification principles. It combines the growth potential of stocks with the stability of bonds. Within the stock allocation, you might further diversify across large and small companies, US and international markets, different sectors and industries. Within the bond allocation, you might hold government and corporate bonds, short-term and long-term maturities, domestic and international issuers. More sophisticated portfolios might add real estate, commodities, even alternative investments we'll discuss later. But the core principle remains. Combine assets that behave differently, that respond differently to economic conditions, that provide different kinds of returns and different forms of protection. As you lie here tonight, perhaps feeling the gentle weight of sleep approaching, let this understanding settle into your consciousness. Asset classes are like instruments in an orchestra. Each has its own voice, its own character, its own role to play. Stocks provide the soaring melody of growth. Bonds provide the steady baseline of stability. Real estate and commodities add harmonic complexity. Cash provides the rests, the pauses, the foundation that lets other instruments shine. Alone, any single instrument can be too much, too monotonous, too vulnerable to the wrong piece being played. But together, properly balanced, they create something more beautiful and more resilient than any could achieve alone. They create a portfolio that can weather economic storms, participate in prosperity, and preserve wealth across the decades of your life. This isn't abstract theory. This is practical wisdom, proven across countless market cycles, available to anyone willing to embrace it. You don't need millions of dollars to benefit from asset class diversification. You can build a simple, diversified portfolio with modest means through index funds and ETFs that provide exposure to all these asset classes efficiently and affordably. The merchants spreading cargo across multiple ships, the farmers planting different crops in different fields, Markowitz proving mathematically why combination reduces risk, they were all pointing toward this same truth. Thoughtful diversification across different types of assets, different geographies, different sources of return creates portfolios that are stronger, more stable, more likely to preserve and grow wealth over time than any concentrated approach. No matter how promising that concentration might seem in the moment, let that wisdom rest gently in your mind as your thoughts begin to drift. Asset classes, correlations, economic cycles, these are just the details, the mechanics of a deeper truth. The deeper truth is that balance protects, that variety strengthens, that spreading risk across different types of investments creates resilience that concentration can never achieve. Sleep well in this knowledge. Dream perhaps of portfolios that weather all storms, of investments that complement and balance each other, of the elegant simplicity underlying the apparent complexity of modern finance. The simple rule that protects millionaires is available to you too. Hold different types of assets, let them balance each other, trust in the mathematics of diversification, and let time do its work. We've explored the building blocks of diversification, those broad asset classes that form the foundation of balanced portfolios. Now let's turn our attention to something more sobering, more human, more instructive in its tragedy. Let's examine what happens when diversification is abandoned, when concentration takes hold, when people, often smart, successful, accomplished people, put too much faith in a single investment, a single company, a single idea. These aren't just cautionary tales. They're windows into human psychology, into the behavioral patterns that lead us astray, into the quiet ways that confidence becomes overconfidence and familiarity becomes dangerous comfort. Move slowly through these stories with me. Let them settle gently, offering lessons without creating anxiety, showing us what to avoid without dwelling in fear. Take a breath. Let yourself sink a little deeper into comfort. These stories are in the past. The people involved have moved on or passed on. We're simply observing, learning, understanding the patterns that repeat across different times and circumstances. Let's begin with Enron, because the Enron story captures so many elements of concentration risk in one tragic package. In the late 1990s, Enron was the darling of Wall Street, an energy company that had transformed itself into something more, a trading powerhouse, an innovator, a glimpse of the future. The company's stock price soared year after year. Fortune magazine named Enron America's most innovative company, 6 years in a row. Working for Enron felt like being part of something special, something destined for greatness. Many Enron employees had significant portions of their retirement savings invested in Enron stock. This wasn't unusual or particularly reckless by the standards of the time. The company encouraged employee stock ownership. The stock had performed spectacularly for years. People who worked there saw the company from the inside, believed in its vision, trusted its leadership. Why wouldn't you invest in your own company, especially when it seemed to be conquering the world? Some employees had 60, 70, even 80% of their retirement accounts in Enron stock. It made intuitive sense to them. They knew the company, they understood the business, they had confidence in their employer, and the stock kept rising, validating their decision year after year. Until it didn't. In October of 2001, Enron announced that it had overstated earnings by hundreds of millions of dollars. The announcement triggered questions, investigations, a cascade of revelations about accounting fraud and hidden debt. Within weeks, the stock began its collapse. From a peak of around $90 per share, it fell to pennies. By December, Enron filed for bankruptcy. 20,000 employees lost their jobs. But more than that, many lost their retirement savings. People who had worked for decades, who had diligently saved, who had done what they thought was prudent, investing in a company they knew and believed in, found their nest eggs wiped out. Retirement dreams evaporated. Financial security, built painstakingly over careers, disappeared. The tragedy wasn't just the fraud, though the fraud was real and criminal. The tragedy was that even if there had been no fraud, even if Enron had been a completely legitimate company, concentrating retirement savings in a single stock, any single stock, was dangerously risky. Companies fail, industries change, even the best businesses face unforeseen challenges. No single stock, no matter how promising, belongs as the majority holding in a retirement account. The employees who lost everything weren't stupid or reckless in any obvious way. They were making a mistake that felt reasonable at the time, a mistake rooted in very human cognitive biases. They suffered from what behavioral economists call familiarity bias, the tendency to prefer things we know over things we don't. Enron was familiar. They saw it every day. They understood it, or thought they did. Foreign stocks, bonds, other investments, those felt abstract, uncertain, less trustworthy than the company whose offices they walked through, whose culture they lived. They also suffered from overconfidence. Working inside Enron, seeing its apparent success, hearing constantly about its innovation and market dominance, they became convinced that Enron was special, that normal rules about diversification didn't apply. This company was different. This company was the future, and they suffered from what's called home bias, though in this case it might be called employer bias. We tend to overinvest in what's close to us, our home country, our home region, our employer. It feels safer because it's familiar, but familiarity doesn't equal safety, sometimes the opposite. The Enron story offers a crucial lesson. Never concentrate your retirement savings in your employer's stock, even if the company is wonderful, even if you believe in it completely. Because you're already concentrated in that company, you work there, your income depends on it, your career is tied to its success. If the company fails, you lose your job and your savings simultaneously. That's the opposite of diversification. That's doubling down on a single risk. Now let's move to a different kind of concentration disaster, one that affected millions of people rather than the employees of a single company. Let's talk about the technology bubble of the late 1990s and its spectacular collapse in 2000. The late 90s were intoxicating if you were invested in technology stocks. The internet was transforming business and communication. New companies were emerging with revolutionary business models. Stock prices were soaring, doubling and tripling, making millionaires seemingly overnight. The Nasdaq, the exchange where most technology stocks traded, rose from around 1,000 in 1995 to over 5,000 in March of 2000. Many investors, both professional and amateur, became heavily concentrated in technology stocks. Why hold boring old industrial companies or utilities when internet stocks were rising 10 or 20% per month? Why diversify into bonds when tech was delivering such spectacular returns? The old rules, the old wisdom about diversification and balanced portfolios, those seemed outdated. Relics of a slower era. This was the new economy. Different rules applied. Portfolio managers who maintained diversified positions, who held only modest technology allocations, were ridiculed. They were called old-fashioned, out of touch, unable to understand the paradigm shift that was occurring. Investors pulled money from diversified funds and poured it into concentrated technology funds. Individual investors built portfolios that were 70, 80, even 90% technology stocks. Then, starting in March of 2000, the bubble began to deflate. Technology stocks fell, they kept falling, and falling. By October of 2002, the Nasdaq had lost about 78% of its value from its peak. Companies that had been valued at billions disappeared. Stocks that had traded at hundreds of dollars per share became worthless. Investors concentrated in technology suffered catastrophic losses. A portfolio that was 80% Nasdaq stocks and 20% bonds would have lost roughly 60% of its value during those 2.5 years. Someone with $100,000 in such a portfolio would have been left with about $40,000. Retirement plans were devastated. College savings accounts were emptied. Wealth that had seemed secure vanished. Meanwhile, investors who had maintained diversified portfolios suffered much smaller losses. Yes, their technology holdings fell, but their bonds held steady or gained value as interest rates fell. Their international stocks, their value stocks, their real estate holdings. These didn't collapse the way US technology stocks did. A traditional balanced portfolio of 60% stocks and 40% bonds, diversified across asset classes and geographies, lost perhaps 15 to 20% during those years. That's painful, certainly, but survivable, and it recovered much faster than concentrated technology portfolios. The lesson here isn't that technology stocks are bad or that growth investing is foolish. Technology companies have created enormous value and wealth over time. The lesson is that concentration in any single sector, any single theme, any single idea, no matter how compelling, is dangerous. Today's sure thing becomes tomorrow's disaster with uncomfortable regularity. Let's consider a different kind of concentration risk, one that many people don't even recognize as risky because it feels so safe, so tangible, so real. Let's talk about real estate concentration, particularly the experience of many Americans leading up to the 2008 financial crisis. In the mid-2000s, housing prices were rising across most of the United States. They'd been rising for years, actually, with only minor interruptions. Many people began to believe that real estate was a one-way bet, that housing prices only went up, that buying as much property as possible was smart investing. People bought second homes, investment properties, vacation homes. They took out home equity loans to buy more real estate. Some became landlords with multiple rental properties. Others flipped houses, buying, improving, and quickly selling. Real estate seemed like a money machine. But more concerning than these active real estate investors were the millions of ordinary homeowners who had most of their net worth concentrated in their homes. They owned a house worth perhaps $300,000 or $400,000. They might have had some retirement savings, but the majority of their wealth was in home equity. And they felt comfortable with this concentration because real estate felt safe. It was a tangible asset. You could see it, touch it, live in it. It wasn't some abstract stock certificate. When the housing market collapsed in 2007 and 2008, home values fell dramatically in many parts of the country. In some markets, prices fell 40, 50, even 60%. A home worth $400,000 became worth $250,000 or less. Homeowners who had borrowed against their homes suddenly owed more than their properties were worth. They were underwater, trapped, unable to sell without bringing cash to closing to pay off the difference between the mortgage and the sale price. Their largest asset, the foundation of their financial security, had become a liability. Those who had concentrated their investments in multiple properties suffered even worse. Landlords who owned 5 rental properties, all financed with mortgages, watched as property values fell and rental income dried up when tenants lost jobs. They couldn't sell without huge losses. They couldn't refinance because the properties were underwater. Many faced foreclosure, losing not just the investment properties but sometimes their primary homes as well. The painful irony is that real estate, as we discussed earlier, is a valuable component of a diversified portfolio. It offers inflation protection, income through rents, low correlation with stocks and bonds. But like any asset class, it becomes dangerous when it dominates your wealth. The people who suffered most in the real estate collapse weren't those who had modest real estate holdings as part of diversified portfolios. They were those who had concentrated heavily in property, believing it couldn't fail. Now let's shift to a more intimate scale, a more personal kind of concentration disaster. Let's talk about Bernie Madoff and the investors who gave him everything. Bernie Madoff ran what appeared to be a successful investment management firm for decades. He was a respected figure in finance, a former chairman of the Nasdaq Stock Exchange, a philanthropist, a member of exclusive clubs. His investment fund reported steady, positive returns year after year, regardless of market conditions. 10% in good years, 8% in bad years, remarkably consistent, reassuringly stable. Many of his investors were wealthy individuals, charities, foundations. Some had invested with Madoff for 20 or 30 years, watching their accounts grow steadily, receiving regular statements showing impressive gains. The relationship felt safe, trusted, proven over decades. Some investors became so comfortable with Madoff that they concentrated enormous portions of their wealth with him. Entire retirement accounts, entire family fortunes, charitable endowments built up over generations. They thought they were being prudent. After all, Madoff's returns were more stable than the volatile stock market. They thought they'd found the ideal investment. Consistent returns, no volatility, managed by a trustworthy established professional. In December of 2008, Madoff confessed that his investment business was a fraud, a Ponzi scheme that had been running for at least 17 years. There were no investments. The steady returns were fiction. New investor money was used to pay returns to existing investors. It was all a lie. And when the financial crisis made it impossible to continue, the scheme collapsed. Investors lost approximately $65 billion. Individuals who had trusted Madoff with their life savings found those savings completely gone. Charities that had built endowments over decades discovered those endowments were worthless. Foundations shut down. Families that had been wealthy became destitute. The concentration mistake here was different from Enron or the tech bubble. This wasn't about picking the wrong stock or sector. This was about concentrating too much wealth with a single manager, trusting one person or one firm with everything. Even if Madoff had been legitimate, even if he had been an honest, skilled investor, giving him such concentrated control over wealth was risky. Managers make mistakes, firms fail, strategies stop working. Diversifying across multiple managers, multiple institutions, multiple approaches protects against any single point of failure. After Madoff, wealthy investors learned to diversify not just their assets, but their advisors. Don't give everything to one person. No matter how trustworthy they seem, spread your wealth across multiple managers, multiple institutions. If one fails or betrays you, you haven't lost everything. This is diversification applied to relationships and institutions, not just investments. Let's consider one more form of concentration risk, one that affects entire communities rather than just individual investors. Let's think about single industry towns and regions, places where economic concentration creates collective vulnerability. Detroit was once the wealthiest city in America, the automotive capital of the world. The big three automakers, General Motors, Ford, Chrysler, employed hundreds of thousands of workers directly and supported countless more jobs indirectly through suppliers and service industries. Families built middle-class lives working in auto plants. The city thrived on the success of a single industry. But when that industry struggled, the entire city suffered. As foreign competition intensified, as manufacturing moved overseas, as automation reduced labor needs, the automotive industry contracted. Detroit's population fell by more than 60% from its peak. Property values collapsed. The tax base eroded. Eventually, the city filed for bankruptcy. Workers who had spent careers in automotive manufacturing found their skills weren't easily transferable to other industries. Homes became worthless because who wanted to move to a dying city? Pensions were cut in the bankruptcy. The concentration that had created prosperity became the source of devastation. Similar stories played out in coal mining regions of Appalachia, in steel towns of the Rust Belt, in timber communities of the Pacific Northwest. When a region's economy is concentrated in a single industry, everyone's fortunes rise and fall together. There's no diversification, no protection when that industry declines. The lesson applies to individual careers too. If your entire skill set is concentrated in a single industry, a single type of work, you're vulnerable to changes in that industry. Diversifying your skills, developing multiple competencies, maintaining flexibility, These are forms of career diversification that parallel financial diversification. What unites all these stories, Enron, the tech bubble, real estate concentration, Madoff, single industry towns, is the seductive logic of concentration. In each case, concentration made sense at the time to the people involved. Enron employees knew their company and believed in it. Tech investors saw real innovation creating real value. Real estate owners held tangible assets that had always appreciated. Madoff investors had decades of steady returns. Workers in thriving industries had good jobs and secure futures. The problem is that concentration only shows its danger when things go wrong. When they're going right, concentration looks brilliant. It delivers higher returns than diversification. It feels safe because you understand it. It seems wise because everyone around you is doing the same thing. The risk is invisible until it materializes, and then it materializes catastrophically. This is why the discipline of diversification matters so much. Diversification forces you to give up some upside, to hold things that aren't performing as well as your best ideas, to spread resources across options that might seem less compelling. It feels inefficient when times are good. But when times turn bad, when the unexpected happens, when the sure thing fails, diversification is what stands between discomfort and disaster. As you rest here tonight, let these stories settle not as sources of anxiety, but as sources of wisdom. The people who suffered these concentration disasters weren't fools. They were making understandable mistakes, following intuitions that felt right, trusting in things that seemed trustworthy. We're all vulnerable to the same mistakes because we're all subject to the same psychological biases. We prefer what's familiar over what's unknown. We become overconfident in our own judgments and abilities. We extrapolate recent trends into the indefinite future. We trust too much in authorities and established institutions. These aren't character flaws. They're features of human cognition that usually serve us well but can lead us astray in investing. The antidote is structure, is discipline, is adherence to principles even when they seem unnecessary. Diversify even when concentration looks more profitable. Rebalance even when it means selling your winners. Hold assets you don't fully understand or believe in because they balance assets you do understand and believe in. Follow the mathematics, the proven principles, the ancient wisdom, rather than the seductive logic of the moment. The simple rule that protects millionaires protected the investors who diversified away from Enron before it collapsed, who maintained balanced portfolios during the tech bubble, who didn't over-concentrate in real estate before 2008, who didn't give Bernie Madoff everything. They didn't necessarily see the specific disasters coming. They just followed the discipline of diversification, and that discipline protected them. You can follow the same discipline. You can learn from these cautionary tales without experiencing the catastrophes yourself. You can build portfolios and careers and lives that spread risk, that don't depend too heavily on any single outcome, that maintain resilience through balance and variety. We've explored the dangers of concentration, those sobering lessons from people who learn too late that putting everything in one place invites catastrophe. Now let's turn to a more practical, more hopeful question, one that every thoughtful investor eventually asks. How much diversification is actually enough? Because there's a point, a threshold, where additional diversification stops providing meaningful benefit and starts creating unnecessary complexity. There's an optimal range where you've captured most of the risk reduction that diversification offers without diluting your returns or making your portfolio impossible to manage. Finding that balance, understanding where it lies, is part of the art and science of building wealth that endures. Take a slow breath. Let yourself settle a little deeper. We're moving from cautionary tales to practical wisdom now, from what to avoid to what to embrace. From fear to understanding. This is where diversification becomes not just a defensive strategy, but an elegant solution to the eternal investment challenge of balancing risk and return. The question of how many individual stocks you need to achieve adequate diversification has been studied extensively by financial researchers over the decades. The findings are both reassuring and somewhat surprising. You don't need hundreds of stocks. You don't even need 100 stocks. The magic number, the point where you've eliminated most of the risk that diversification can eliminate, appears to be somewhere between 20 and 30 individual stocks. Let me explain why this is, because understanding it helps you see both the power and the limits of diversification. When you own a single stock, you bear two types of risk. The first is systematic risk, also called market risk, the risk that affects all stocks together. When the entire economy enters recession, when interest rates rise unexpectedly, when global events create uncertainty, nearly all stocks fall together. This is systematic risk, and diversification can't eliminate it because it affects everything simultaneously. The second type is unsystematic risk, also called company-specific or idiosyncratic risk. This is the risk unique to that particular company. Its management makes poor decisions, its products become obsolete, it faces lawsuits or scandals. Competitors take market share. This risk is specific to that one company and largely independent of what happens to other companies. When you own just one stock, you bear all of its unsystematic risk. If that company stumbles, your investment suffers. But when you add a second stock, particularly one in a different industry or with different characteristics, you've reduced your unsystematic risk. If the first company stumbles but the second thrives, they partially offset each other. The portfolio is more stable than either stock alone. Add a third stock, a fourth, a fifth, and with each addition you're further reducing unsystematic risk. The impact of any single company's problems becomes smaller because it represents a smaller portion of your portfolio. A portfolio of 10 stocks is significantly more stable than a portfolio of 5 stocks. Each individual stock represents only 10% of your wealth rather than 20%, so any single company's failure does less damage. But here's the interesting part, the point where the mathematics of diversification reveals its limits. The risk reduction you get from adding stocks follows a curve of diminishing returns. The first few additions provide substantial risk reduction. Going from 1 stock to 5 stocks dramatically reduces volatility. Going from 5 stocks to 10 provides meaningful additional benefit. Going from 10 to 20 still helps noticeably. But going from 20 to 40 provides much smaller incremental benefit. And going from 40 to 80 provides even less. By the time you own 20 to 30 stocks across different industries and sectors, you've eliminated roughly 90 to 95% of the unsystematic risk that diversification can eliminate. The remaining 5 to 10% is so small that adding more stocks doesn't meaningfully reduce it. Studies have shown that a portfolio of about 30 randomly selected stocks has nearly the same volatility as a portfolio containing hundreds or even thousands of stocks. You've captured essentially all the diversification benefit available from increasing the number of holdings. Everything beyond that point is just complexity without reward. This is deeply reassuring for individual investors. You don't need to own the entire market. You don't need hundreds of holdings. A portfolio of 25 to 35 well-chosen stocks, spread across different sectors and industries, gives you nearly all the protection that diversification can provide. More might not hurt, but it doesn't help much either. Of course, there's a caveat here, an important one. Those 20 to 30 stocks need to actually be diversified. If you own 30 technology companies, you're not diversified. You're concentrated in a single sector. If you own 30 companies that all depend on the same economic conditions, the same commodity prices, the same regulatory environment, you're not truly diversified even though you own 30 different names. True diversification means spreading across sectors, technology, healthcare, consumer goods, financials, industrials, energy, utilities. It means including companies of different sizes, large established corporations, medium-sized growth companies, small emerging businesses. It means geographic diversity, not just American companies but international exposure as well. When researchers talk about 20 to 30 stocks providing adequate diversification, they mean 20 to 30 truly diverse holdings, not 20 to 30 variations on the same theme. The correlation between your holdings matters as much as the number of holdings. 10 stocks with low correlation to each other can be more diversifying than 50 stocks that all move together. This brings us to a related danger, one that sophisticated investors sometimes fall into even when they think they're well diversified. It's called over-diversification, or, more colourfully, diworsification, a portability of diversification and worse, suggesting that too much diversification makes things worse rather than better. Over-diversification happens when you own so many investments that you're essentially just replicating a market index, but with higher costs and complexity. Imagine you own 100 stocks carefully selected from across the market. If those 100 stocks are chosen broadly enough, your portfolio will perform almost exactly like the entire stock market. Your returns will be nearly identical to a simple index fund, but you've done far more work, paid more in transaction costs, created more complexity to track and manage. If you're going to own the entire market, there are simpler ways to do it. Index funds and exchange-traded funds, which we'll discuss more in a moment, allow you to own thousands of stocks through a single investment, achieving maximum diversification with minimum complexity and cost. Trying to build your own version of a market index through individual stock selection is inefficient and ultimately pointless. The art of portfolio construction lies in finding the balance. Enough holdings to eliminate most unsystematic risk. Few enough that you can actually understand what you own, why you own it, and how the pieces fit together. Diverse enough across sectors, geographies, and characteristics that your holdings don't all rise and fall together. Focused enough that you're not just mimicking an index you could buy more cheaply and simply. For most individual investors, this sweet spot is probably somewhere between 20 and 50 individual stock positions, complemented by other asset classes, bonds, real estate, perhaps commodities or other alternatives. That's enough to capture the benefits of diversification without creating overwhelming complexity. But many investors, perhaps most, don't need to build portfolios from individual stocks at all. This is where index funds and exchange-traded funds have revolutionized investing, making broad diversification available to everyone, not just those with substantial wealth or sophisticated knowledge. An index fund is a mutual fund designed to track a market index, the S&P 500, the total US stock market, international developed markets, bonds, real estate investment trusts, whatever segment of the market you want exposure to. By buying a single share of an index fund, you own proportional pieces of every holding in that index. A total stock market index fund might hold 3,000 or 4,000 individual stocks. One purchase, complete diversification. The costs are minimal, often just a few hundredths of a percent per year. The complexity is minimal. You don't need to research individual companies, track earnings reports, worry about individual stock risks. You simply own the market in whatever proportions the market exists. Your returns will match the market return, minus those tiny fees. You'll never beat the market with this approach, but you'll never significantly lag it either. You get market returns reliably, predictably, with minimal effort and cost. Exchange-traded funds work similarly, but trade like stocks during market hours, offering slightly more flexibility. The principle is the same. Broad diversification, low cost, simplicity. For someone building a diversified portfolio in the modern era, index funds and ETFs make it remarkably easy. You might own just 3 or 4 funds, one for US stocks, one for international stocks, one for bonds, perhaps one for real estate, and achieve diversification that would have required dozens or hundreds of individual security purchases in previous generations. This is diversification democratized, available to anyone regardless of wealth or sophistication. The wealthy and institutions have access to additional layers of diversification that most individuals don't. They can invest in private equity, hedge funds, venture capital, directly owned real estate, commodities, infrastructure, farmland, timberland, art, collectibles. These alternative investments often have low correlation with traditional stocks and bonds, providing additional diversification benefits. But here's an important truth that should be comforting rather than discouraging. The marginal benefit of these exotic investments over a well-constructed portfolio of stocks, bonds, and real estate is smaller than you might think. Yes, alternatives add value through further diversification, but a simple portfolio of low-cost index funds covering major asset classes gets you perhaps 80 or 85% of the way there. The additional complexity of alternatives adds incremental improvement, not revolutionary transformation. This is liberating. You don't need access to exclusive investments or sophisticated strategies to build a genuinely diversified portfolio. The tools available to ordinary investors, index funds, ETFs, straightforward asset allocation, are powerful enough to capture most of the benefits that diversification offers. More can be added if available and appropriate, but it's not necessary for success. Let's think about diversification across market capitalizations, because this is another dimension that matters. Market capitalization, the total value of a company calculated by multiplying its share price by the number of shares outstanding, determines whether a company is considered large cap, mid cap, or small cap. Large cap companies are the giants: Apple, Microsoft, Amazon, Johnson & Johnson. They're established, globally dominant, relatively stable. They tend to be more resilient during market downturns but grow more slowly during expansions. They've already captured most of their market, already achieved most of their growth potential. Small cap companies are smaller, often less well-known businesses. They're riskier, more likely to fail, more volatile, more vulnerable to economic cycles. But they also have more room to grow, more potential to multiply in value if they succeed. A small company that captures an emerging market can increase tenfold or more. Large companies rarely multiply that way. There's simply not enough room for a $1 trillion company to become a $10 trillion company. Mid-cap companies fall between these extremes, offering moderate stability and moderate growth potential. Historical data shows that including all three size categories in your portfolio provides better diversification than owning only large cap stocks. Small and mid-cap stocks have different return patterns, different risk characteristics, different sensitivities to economic conditions. They don't move in perfect lockstep with large caps, so combining them reduces overall portfolio volatility while maintaining or enhancing returns. This doesn't mean you need equal allocations to each. Most investors tilt toward large caps because they're more liquid, more stable, easier to research and understand. But having some exposure to mid and small caps, perhaps 20 to 30% of your stock allocation, adds meaningful diversification without excessive risk. International diversification deserves special emphasis because it's an area where many investors remain under-diversified, often without realizing it. This is called home bias, the tendency to invest primarily in your home country's market, even when international opportunities offer better diversification. American investors tend to hold 80, 90, even 100% of their stock allocation in US companies. This feels comfortable. We know these companies, we use their products, we understand the economic and political environment. Foreign markets seem riskier, more uncertain, harder to analyze. But the United States, while it's the world's largest economy, represents only about half of global economic output and less than half of global stock market value. Europe, Japan, China, emerging markets across Asia, Latin America, Africa. Together, these represent more economic activity and more investment opportunity than the US alone. Limiting yourself to US stocks means ignoring more than half the world's investment universe. Moreover, international markets don't move in perfect correlation with US markets. Sometimes they outperform when US markets lag. Sometimes they provide stability when US markets are volatile. During the decade of the 2000s, international stocks significantly outperformed US stocks. During the decade of the 2010s, US stocks outperformed international. No one knows which will lead in the decades ahead. So holding both provides protection against backing the wrong horse. Currency diversification matters too. When you own international stocks, you're implicitly owning foreign currencies. If the dollar weakens, your international holdings become more valuable when converted back to dollars, providing a hedge against dollar decline. If the dollar strengthens, you give back some gains, but you likely benefit from stronger US stock performance. Financial advisors often recommend that international stocks comprise 25 to 40% of your stock allocation. This provides meaningful geographic diversification without over-concentrating in markets that might be less efficient, less transparent, or less politically stable than US markets. Within international investing, you face choices between developed markets, Europe, Japan, Australia, Canada, and emerging markets like China, India, Brazil, Mexico. Developed markets are more stable but slower growing. Emerging markets are riskier but offer higher growth potential. Most investors hold both, tilting toward developed markets for stability, while maintaining some emerging market exposure for growth. The principle remains consistent across all these dimensions: size, geography, sector, style. Diversify across categories that have different characteristics, different return patterns, different risk profiles. Don't put all your eggs in one basket, and recognize that baskets come in many forms. The basket of US stocks is different from the basket of international stocks. The basket of large cap is different from small cap. Technology is different from healthcare, is different from consumer goods. By spreading across these baskets thoughtfully, by holding positions across the dimensions of difference, you create portfolios that are resilient to whichever winds blow, that participate in whatever succeeds while being protected against whatever fails. As you rest here tonight, as sleep begins to pull you gently downward, let this practical wisdom settle into your understanding. You don't need perfection. You don't need hundreds of holdings or access to exotic investments. You need enough diversification to eliminate most unsystematic risk, probably 20 to 30 individual stocks if you're picking stocks, or a handful of well-chosen index funds covering major asset classes and geographies. You need true diversity across sectors, sizes, and regions. You need to avoid overconcentration in any single theme or idea, no matter how compelling. You need to resist the temptation to over-diversify into meaningless complexity, and you need to remember that sometimes simple is better, that the low-cost index fund covering thousands of stocks is often superior to the hand-picked portfolio of 50 holdings that took hours to research and years to accumulate. The wealthy have more options, more access to alternatives and sophisticated strategies. But the core benefits of diversification are available to everyone. The simple rule that protects millionaires: spread your risk, hold different things, embrace variety and balance. That rule works at any wealth level, whether you have millions or thousands, whether you're investing through exclusive private funds or public index funds. We've explored how to diversify across investments, understanding that 20 to 30 well-chosen stocks, or a handful of thoughtful index funds, can provide most of the protection that diversification offers. But there's another dimension to diversification, one that's equally important but often overlooked. It's the dimension of time. Let your breathing slow. Feel yourself sinking deeper into rest. We're moving now from what you own to when you invest, from the composition of your portfolio to the timing of your decisions. And what we'll discover is that spreading your investments across time can be just as powerful as spreading them across different assets. Time is a form of diversification. When you invest consistently over years and decades through different market conditions and economic cycles, you protect yourself from the catastrophic mistake of putting everything into the market at exactly the wrong moment. You average out the ups and downs. You remove the pressure to predict the future. You let time itself become your ally. There's a strategy with an ungainly name but elegant simplicity: dollar cost averaging. The concept is straightforward. Instead of investing a lump sum all at once, you invest fixed amounts at regular intervals, perhaps monthly, perhaps quarterly, regardless of market conditions. You invest the same dollar amount whether the market is up or down, expensive or cheap, optimistic or pessimistic. Let's think about why this works, why it matters, why it removes one of investing's most vexing challenges. Imagine you've received a windfall, an inheritance perhaps, or the proceeds from selling a business. You have $100,000 to invest. The question that immediately confronts you is, should I invest it all right now, or should I spread it out over time? If you invest everything immediately and the market rises over the next year, you'll be glad you did. You'll have captured all the gains. But if the market falls over the next year, you'll regret not waiting. You'll have bought at high prices just before the decline. This timing risk, this uncertainty about whether now is the right moment to invest, creates anxiety and often leads to paralysis. Dollar cost averaging provides a third option. Instead of investing the $100,000 all at once, you invest it gradually, perhaps $10,000 per month for 10 months, or approximately $8,300 per month for 12 months. Each month, regardless of what the market did last month or might do next month, you invest your planned amount. What happens with this approach? When the market is high and prices are expensive, your fixed investment buys fewer shares. When the market is low and prices are cheap, that same fixed investment buys more shares. Over time, you end up with an average purchase price that's somewhere between the highs and lows. You've automatically bought more when things were cheap and less when things were expensive, without having to predict which was which. Let me give you a concrete example with gentle, easy numbers. Suppose you're investing $1,000 per month in a stock index fund. In January, the fund's price is $50 per share, so your $1,000 buys 20 shares. In February, the market has risen, and the price is now $60 per share, so your $1,000 buys about 16.7 shares. In March, the market has fallen and the price is $40 per share, so your $1,000 buys 25 shares. After 3 months, you've invested $3,000 and purchased about 62 shares. Your average price per share is roughly $48, less than the simple average of the 3 prices, which would be $50. This happens because you automatically bought more shares when the price was lowest. You practiced good investing discipline. Buy more when cheap, buy less when expensive, without having to predict or time anything. The beauty of dollar cost averaging is that it removes emotion from the equation. You don't have to decide whether now is a good time to invest. You don't have to predict whether the market will rise or fall. You just follow the plan. Month after month, year after year, you invest your set amount. The market's movements become irrelevant to your decision-making. You're investing through the cycles, not trying to time them. This approach is particularly valuable during volatile periods. Think about the year 2008, during the financial crisis. The market fell dramatically, day after day, week after week. Investors who were dollar cost averaging through this period were buying shares at lower and lower prices, accumulating positions that would prove enormously valuable when the market eventually recovered. It probably didn't feel good at the time. Watching your investments fall month after month never feels good. But the discipline of continuing to invest, of buying more when prices were depressed, positioned them beautifully for the recovery. Someone who had invested a lump sum in early 2008 and then watched it fall 40% would have needed tremendous courage to hold on. Many people didn't. They sold near the bottom, locking in losses, unable to bear the psychological pain of watching their wealth evaporate. But someone dollar-cost averaging through the crisis never faced that all-at-once loss. They saw their existing holdings decline, yes, but each new investment was buying at increasingly attractive prices. They were building positions for the future, while others were capitulating in despair. Of course, dollar-cost averaging isn't perfect. If the market rises consistently without significant pullbacks, investing a lump sum immediately would have produced better returns. You'd have been fully invested for the entire rise rather than gradually entering. Studies have shown that, on average, lump sum investing outperforms dollar-cost averaging because markets trend upward over time. Starting fully invested captures more of that upward trend. But averages don't capture the human experience of investing. The psychological value of dollar-cost averaging, the reduced anxiety, the removal of timing pressure, the discipline it enforces, has worth beyond what numerical averages can measure. Many investors sleep better spreading investments over time. And sleeping better has value. Peace of mind has value. The confidence to stay invested during inevitable downturns has value. For most people who are accumulating wealth gradually through savings from income, dollar-cost averaging isn't even a choice. It's the natural result of investing what you save each month or each paycheck. You receive income regularly. You save a portion. You invest those savings. You're dollar-cost averaging by default, and this is perfectly appropriate. You're spreading your entry into the market across your entire career, averaging out decades of market conditions. This leads us to rebalancing, another form of time-based diversification that's equally important and perhaps even more psychologically challenging. Remember when we discussed asset allocation, the idea of holding different percentages in stocks, bonds, real estate, other asset classes? Perhaps you decided on a 60% stock, 40% bond allocation. You carefully constructed your portfolio to match these targets. But markets move, some assets rise while others fall. Over time, your actual allocation drifts away from your target. Imagine your portfolio starts the year with $60,000 in stocks and $40,000 in bonds, matching your 60-40 target. Stocks have a great year, rising 20% while bonds return just 3%. By year end, your stocks are worth $72,000 and your bonds are worth $41,200. Your total portfolio is now $113,200, but your allocation has shifted to about 64% stocks and 36% bonds. You're now overweight stocks relative to your target. You've drifted from your intended allocation. This is where rebalancing comes in. Rebalancing means periodically adjusting your portfolio back to your target allocation. In this case, you'd sell some stocks and buy bonds, bringing yourself back to 60-40. The numbers are straightforward. To get back to 60-40, you'd need $67,920 in stocks and $45,280 in bonds. So you'd sell about $4,000 of stocks and use the proceeds to buy bonds. You're back at your target allocation. But notice what you've done. You've sold some of your winners, stocks, which just had a great year, and bought more of your laggards, bonds, which underperformed. This feels wrong. Every instinct says to ride your winners, to keep holding what's working, to avoid what's lagging. Rebalancing forces you to do the opposite. This is precisely why rebalancing works. It imposes the discipline of selling high and buying low. When stocks have run up, you're taking some profits, locking in gains, reducing your exposure to what's become expensive. When bonds have lagged and become a smaller portion of your portfolio, you're buying more at relatively cheaper prices. You're following the fundamental rule of successful investing: buy low, sell high, through a mechanical process that requires no prediction, no market timing, no special insight. Rebalancing also maintains your risk profile. As stocks rise and become a larger portion of your portfolio, you're taking on more risk than you intended. you're more exposed to a stock market decline. By rebalancing back to your target, you're keeping your risk level consistent with your plan, your time horizon, your ability to sleep at night. The psychological difficulty of rebalancing cannot be overstated. In 2008, when stocks had fallen dramatically and bonds had held steady or risen, proper rebalancing meant selling bonds and buying more stocks, buying more of what was falling catastrophically, buying when fear was rampant and every instinct screamed to get out. To protect yourself, to stop the bleeding. The investors who had the discipline to rebalance in late 2008 or early 2009, buying stocks near the bottom, reaped extraordinary rewards in the recovery. But it took tremendous courage. Similarly, in 2000, when the technology bubble was at its peak, proper rebalancing meant selling some of your soaring tech stocks and buying more of the boring value stocks and bonds that had lagged, selling your winners to buy your losers. Most investors did the opposite, pouring more money into tech stocks that had already run up dramatically. When the bubble burst, those who had rebalanced were protected. Those who had chased performance suffered catastrophic losses. There are different approaches to rebalancing. Some investors rebalance on a fixed schedule, perhaps annually, perhaps quarterly. Every January 1st, you check your allocations, calculate what needs to be bought or sold to return to targets, and execute the trades. The advantage is simplicity and discipline. The disadvantage is that you might rebalance when nothing meaningful has changed, incurring unnecessary transaction costs and taxes. Other investors use threshold-based rebalancing. You only rebalance when your allocation has drifted beyond a certain threshold, perhaps 5 percentage points from target. If your stocks should be 60% but have drifted to 66%, you rebalance. If they're at 62%, you leave them alone. This reduces unnecessary rebalancing while still maintaining discipline. Tax considerations matter in rebalancing. In taxable accounts, selling appreciated assets triggers capital gains taxes. This doesn't mean you shouldn't rebalance, but it means you need to be thoughtful. Sometimes you can rebalance through new contributions, directing new money to underweight asset classes rather than selling overweight ones. Sometimes you can rebalance within tax-advantaged retirement accounts where trades don't trigger taxes. The long-term data on rebalancing is clear. Portfolios that are regularly rebalanced to maintain target allocations have historically achieved better risk-adjusted returns than portfolios left adrift. The rebalanced portfolios maintained more consistent risk profiles and avoided the extremes of being too aggressive after market rises or too conservative after market falls. They enforced discipline, removed emotion, and kept investors aligned with long-term plans rather than short-term market movements. Time horizon itself is a form of diversification, though we don't often think of it that way. The longer your time horizon, the more risk you can afford to take, because you have time to recover from downturns. Young investors saving for retirement decades away can hold aggressive portfolios because short-term volatility doesn't matter. They'll experience multiple market cycles. Downturns will be followed by recoveries. Time smooths the ride. Older investors approaching or in retirement have shorter time horizons. They can't afford to lose half their wealth in a market crash because they might not live long enough to see the recovery. They need more conservative portfolios, more bonds and cash, less exposure to stocks. Their shorter time horizon requires different diversification, more stability, less growth potential. This introduces the concept of a glide path. The gradual shift from aggressive to conservative allocations as you age. Target date retirement funds follow this approach automatically. If you're planning to retire in 2040, you buy a 2040 target date fund. It starts aggressive when you're young, gradually shifts to more conservative allocations as 2040 approaches, and becomes quite conservative once you're in retirement. You're diversifying across time by adjusting your risk exposure to match your changing time horizon. Sequence of returns risk is another temporal consideration that rebalancing helps address. The order in which you experience returns matters, especially near retirement. If you experience strong returns early in retirement, you're in good shape. But if you experience strong losses early in retirement while you're withdrawing money to live on, you can deplete your portfolio before the recovery comes. Rebalancing helps mitigate this risk. By taking some profits during good years and building up bond and cash positions, you create a buffer that can fund spending during bad years without having to sell stocks at depressed prices. You're diversifying across time by creating flexibility about when you need to sell which assets. As you drift towards sleep now, as these concepts about time and discipline settle into your consciousness, let yourself find comfort in the structure they provide. Dollar cost averaging removes the burden of timing, of trying to predict the perfect moment to invest. Rebalancing enforces the discipline of selling high and buying low without requiring you to predict which is which. Time horizon adjustments ensure your portfolio matches your stage of life. These aren't exotic strategies requiring special knowledge or access. They're simple, mechanical approaches that anyone can follow. Set up automatic monthly investments from your paycheck into a diversified portfolio, your dollar cost averaging. Once a year, check if your allocations have drifted more than 5 percentage points from targets and adjust if needed, your rebalancing. Gradually shift from stocks to bonds as you approach retirement. You're adjusting for time horizon. The wealthy might have more sophisticated versions of these strategies, more complex rebalancing algorithms, more nuanced glide paths. But the core principles work at any wealth level. Time-based diversification is democratic, available to all, requiring only discipline and patience rather than money or expertise. Think of time as another dimension of the diversification matrix. You diversify across asset classes, stocks, bonds, real estate. You diversify across geographies, domestic and international. You diversify across sizes, large cap, mid cap, small cap. And you diversify across time, through regular investment, through rebalancing, through adjusting as your life circumstances change. Each dimension adds protection, reduces risk, creates resilience. Together, they build portfolios that can weather whatever comes, that don't depend on perfect timing or prescient prediction, that simply persist through decades of changing conditions, accumulating wealth gradually but reliably. We've explored how time itself becomes a dimension of diversification, how regular investment and disciplined rebalancing protect us from the perils of timing. Now let's lift our perspective. Let's look beyond the strategies available to everyone and peek into the world of significant wealth, where diversification takes on additional layers, additional complexity, additional sophistication. Let your breath slow even further. Feel the weight of your body sinking into rest. We're moving into territory that might seem distant from your own experience, but the principles remain the same, and the insights apply regardless of wealth level. Sometimes understanding how the very wealthy approach diversification reveals truths about what truly matters in protecting and preserving wealth. There's an interesting paradox at the heart of great wealth. Most fortunes are created through concentration, not diversification. Someone builds a business, holds concentrated ownership in that business, and if the business succeeds spectacularly, they become wealthy. Bill Gates concentrated in Microsoft. Warren Buffett concentrated in Berkshire Hathaway. Jeff Bezos concentrated in Amazon. Mark Zuckerberg concentrated in Facebook. The list goes on. Concentration creates wealth, but concentration also destroys wealth. For every Gates or Bezos, there are thousands of entrepreneurs whose concentrated bets failed, whose businesses collapsed, whose fortunes evaporated. We see the winners and forget the countless losers. Survivorship bias makes concentration look smarter than it actually is. The truly interesting thing, though, is what happens after wealth is created through concentration. Almost universally, the wealthy diversify. They take chips off the table. They spread their wealth across multiple investments, multiple asset classes, multiple geographies. They've learned the lesson that ancient merchants knew. Preservation requires diversification. Warren Buffett himself, despite building his fortune through concentrated stock picking, advises most people to simply buy low-cost index funds and hold them forever. Broad diversification. Simple strategy. Even the master of concentrated investing recognizes that most people are better served by diversification than by trying to replicate his approach. Let's think about how the ultra-wealthy, those with tens or hundreds of millions or billions, approach diversification differently from those with more modest wealth. Not because their principles are different, but because their scale allows access to investments and strategies that aren't available to everyone. Alternative investments form a significant portion of many wealthy portfolios. These are investments beyond traditional stocks and bonds. Private equity, where you invest in companies that aren't publicly traded. Hedge funds, which use sophisticated strategies to generate returns uncorrelated with market movements. Venture capital, investing in early-stage companies with high risk but potentially enormous returns. Real assets like farmland, timberland, infrastructure, commercial real estate held directly rather than through publicly traded vehicles. These alternatives offer several potential benefits. First, they often have low correlation with public stock markets. When the stock market falls, your private equity holdings might be unaffected because they're valued less frequently and aren't subject to daily market panic. Your farmland continues producing crops regardless of what the S&P 500 does. Your infrastructure investments generate steady cash flows whether markets are up or down. Second, alternatives sometimes offer access to returns that aren't available in public markets. Venture capital can generate extraordinary returns by investing in the next Google or Facebook before they go public. Private equity can buy underperforming companies, improve them, and sell them for substantial profits. These opportunities aren't available through buying public stocks. Third, alternatives add layers of diversification that enhance portfolio stability. A portfolio containing stocks, bonds, real estate, commodities, private equity, hedge funds, and hard assets has more moving parts, more sources of return, more protection against any single market or asset class performing poorly. But alternatives also have significant drawbacks that explain why they're not suitable for everyone. They're illiquid, meaning you can't easily sell them when you need cash. Private equity funds typically lock up your money for 7 to 10 years. Farmland takes time to sell. You can't just click a button and liquidate like you can with stocks or bonds. They're expensive. Alternative investments often charge much higher fees than traditional investments. A hedge fund might charge 2% of assets annually, plus 20% of profits. Private equity has similar fee structures. These fees eat into returns, and the investment needs to perform significantly better than public market alternatives just to break even after fees. They're complex and opaque. Understanding what a hedge fund is actually doing with your money requires sophisticated financial knowledge. Evaluating private equity deals requires industry expertise. Assessing whether farmland is fairly priced requires understanding agriculture, commodity markets, water rights, climate trends. Most individual investors lack this expertise. They often have high minimum investments. Venture capital funds might require commitments of $1 million or more. Real estate syndications might require $100,000 minimum. These minimums exclude most investors entirely, and crucially, they're often restricted to accredited investors. Those with either $1 million in net worth excluding primary residence or annual income exceeding $200,000. This regulatory restriction exists because alternatives are considered riskier and more complex, suitable only for sophisticated investors who can afford losses. So while alternatives provide genuine diversification benefits, they're not accessible to everyone, and they're not necessary for successful investing. The core portfolio of stocks, bonds, and real estate accessible through public markets provides the vast majority of diversification benefits. Alternatives are icing on the cake, not the cake itself. Geographic and currency diversification takes on additional dimensions for the very wealthy. They might literally have assets in multiple countries, bank accounts in multiple currencies, real estate in multiple continents. If you have $100 million, keeping all of it in dollar-denominated assets in the United States might feel uncomfortably concentrated. You're exposed to US political risk, US economic risk, dollar currency risk. Wealthy individuals diversify across jurisdictions. Perhaps they hold Swiss francs and euros alongside dollars. Perhaps they own property in London, Paris and Singapore, as well as New York. Perhaps they have corporate entities established in multiple countries to manage different parts of their wealth. This isn't about tax evasion, though that's sometimes a motivation. It's about not putting all eggs in the basket of a single country's economic and political stability. This geographic diversification protects against tail risks, those low probability but high impact events that could devastate concentrated wealth. Imagine holding all your wealth in a single country that experiences hyperinflation, political upheaval, or asset confiscation. Unlikely in developed democracies, yes, but history shows it's not impossible. Argentina, once one of the world's wealthiest nations, experienced multiple economic collapses that destroyed peso-denominated wealth. Germans holding only marks in the early 1920s saw their savings obliterated by hyperinflation. Wealthy families who had diversified across borders survived these catastrophes. Those who hadn't were ruined. For ordinary investors, true international diversification, holding actual property and bank accounts in multiple countries, is impractical. But the principle still applies. Holding international stocks and bonds provides exposure to foreign economies and currencies. It's a simpler, more accessible version of the same strategy wealthy individuals pursue more elaborately. Diversification of advisors and institutions is another practice common among the wealthy that makes sense at scale, but becomes impractical below certain wealth levels. We discussed Bernie Madoff earlier, how investors who gave him everything lost everything. Wealthy individuals learned from this and other scandals. Don't concentrate your wealth with a single advisor or institution. A family with $50 million might work with 3 or 4 different wealth management firms, each managing a portion of the portfolio. They might have accounts at multiple banks. They might use different law firms for different purposes, different accounting firms for different entities. This diversification protects against advisor fraud, institutional failure, or simply poor decision-making by any single professional. If one advisor turns out to be incompetent or dishonest, you've lost perhaps 25% of your wealth, not 100%. If one bank fails or freezes accounts, you have other accounts elsewhere. If one strategy underperforms dramatically, other advisors pursuing different strategies might compensate. You've diversified across human judgment and institutional risk. For someone with $200,000, paying 4 different advisors is impractical. The fees would consume too much of the portfolio, but the principle still applies at a smaller scale. Perhaps you use one advisor for investment management, but a different attorney for estate planning. Perhaps you have accounts at 2 different brokerage firms. Perhaps you cross-check advice by getting second opinions on major decisions. You're implementing the same diversification principle at a scale appropriate to your wealth. Collectibles and passion investments represent another area where wealthy diversification diverges from standard practice. Art, wine, classic cars, rare books, jewelry, watches, antiques. These can form meaningful portions of wealthy portfolios. They're not financial assets in the traditional sense. They don't generate cash flows or dividends, but they can appreciate significantly. They have low correlation with financial markets, and they provide enjoyment and prestige beyond mere financial return. A wealthy collector might have millions invested in contemporary art. If the art appreciates, wonderful. If it doesn't, they still enjoy looking at it, lending it to museums, participating in the art world. The investment has non-financial returns that offset financial risk. This is diversification into assets that serve multiple purposes, reducing the pressure on any single purpose to justify the allocation. For ordinary investors, this might translate to having a modest wine collection or collecting something you're passionate about. You're not doing it primarily for investment, but if it appreciates, that's a bonus. You've diversified into tangible assets you enjoy while maintaining the core portfolio in traditional investments. The scale is different, but the concept of combining financial and non-financial returns in a diversified portfolio applies. Income stream diversification is perhaps the most important lesson from how the wealthy approach financial security. They don't rely on a single source of income. They have multiple businesses, investment income from different sources, real estate generating rents, royalties from intellectual property, dividends from stocks, interest from bonds, distributions from trusts and partnerships. If one income stream dries up, others continue. If one business fails, others succeed. This diversification of income is analogous to diversification of assets. You're spreading the risk of depending on any single source of cash flow. If you work for a salary, all your income comes from one employer. If that employer lets you go, your income drops to zero. This is income concentration, and it's risky. The wealthy address this by building multiple income streams. For ordinary people, this might mean developing a side business, building a rental property, creating passive income through dividend stocks, developing skills that allow freelance work. Each additional income stream reduces dependence on any single source and creates resilience against job loss or industry decline. Family offices represent the ultimate expression of sophisticated wealth management and diversification. A family office is essentially a private wealth management firm that serves a single wealthy family. It handles all aspects of the family's finances, investments, tax planning, estate planning, philanthropy, even paying bills and managing household staff. Large family offices, serving families with hundreds of millions or billions in wealth, employ teams of professionals. They have investment specialists, tax attorneys, estate planners, risk managers. They can access the most exclusive investments, negotiate better fees, implement tax strategies that require significant infrastructure. They think multi-generationally about preserving and growing wealth across decades and centuries. The diversification strategies employed by family offices are extraordinarily sophisticated. They might have direct investments in private companies, limited partnerships in real estate developments, exposure to commodities through futures and options, inflation-protected securities, structured products, you name it. They're building portfolios across every possible dimension of diversification: asset class, geography, currency, time horizon, liquidity, manager, strategy, everything. But here's the crucial insight. While the complexity is impressive, the underlying principles aren't different from what we've discussed throughout this journey. Spread risk across different investments. Don't concentrate in any single area. Balance growth and stability. Adjust for time horizon. Maintain discipline through rebalancing. These principles scale from a family office managing billions to an individual managing thousands. The tools available at different wealth levels differ dramatically. The minimum complexity required differs. The sophistication of strategies differs. But the fundamental wisdom remains constant. Diversification protects wealth. Whether you're protecting $10,000 or $10 billion, the principle is the same. As you lie here tonight, perhaps feeling sleep drawing closer, let this perspective settle into your understanding. The simple rule that protects millionaires and billionaires is the same rule that protects anyone: diversify. The expression of that rule changes with scale. The complexity changes. The specific investments change, but the principle endures. You don't need access to private equity or hedge funds or family offices to benefit from diversification. You don't need Swiss bank accounts or property on 3 continents. You need thoughtful allocation across stocks and bonds and perhaps real estate. You need geographic diversification through international index funds. You need discipline in rebalancing. You need to avoid concentration in your employer's stock. You need to develop multiple income streams if possible. These practices, available to anyone regardless of wealth, capture the essential benefits of diversification. The sophisticated strategies of the wealthy add incremental improvement. But the foundation is the same foundation available to all. A well-diversified portfolio of low-cost index funds across major asset classes and geographies gets you perhaps 85% of the way to optimal diversification. Everything beyond that is refinement, not revolution. Let that be comforting rather than frustrating. You don't need billions to benefit from the wisdom of diversification. You don't need access to exclusive investments or sophisticated strategies. You need understanding, discipline, and patience. These are democratic virtues, available to all who choose to pursue them. Sleep well in this knowledge. Dream, perhaps, of portfolios that grow steadily across decades, of wealth built gradually through discipline rather than dramatically through speculation, of security that comes from balance and variety rather than from hitting the jackpot with a single concentrated bet. The wealthy diversify because they understand that preservation matters as much as accumulation, that surviving to invest another day matters more than maximizing returns in any single period, that resilience comes from spreading risk across multiple dimensions. They learned this wisdom through experience, through watching concentrated fortunes evaporate, through understanding that what concentration creates, concentration can destroy. You can learn the same wisdom without having to experience the same losses. You can build diversified portfolios from the beginning, before you have millions, before you need family offices and hedge funds and international property. You can implement the simple rule that protects millionaires starting today, starting with whatever wealth you currently possess. Building across time through regular investment and disciplined rebalancing. We've explored how the wealthy approach diversification with layers of sophistication unavailable to most investors, yet we discovered the core principles remain constant across all wealth levels. Now let's turn our attention to the present moment, to the newest frontiers of investing, to the question of how emerging asset classes fit into the timeless framework of diversification. Let your breathing find its slowest rhythm. Feel yourself drifting deeper into rest. We're moving into contemporary territory now, into assets that didn't exist when Harry Markowitz developed modern portfolio theory, into investments that challenge traditional categories and correlations, but we'll find that even these new frontiers are illuminated by ancient wisdom about spreading risk and maintaining balance. The most prominent new asset class of recent years is cryptocurrency, led by Bitcoin but encompassing thousands of digital currencies and tokens. Understanding how cryptocurrency fits into diversification requires understanding what it actually is, how it behaves, and whether it truly provides the uncorrelated returns that make diversification valuable. Bitcoin was created in 2009 by an anonymous person or group using the name Satoshi Nakamoto. It was designed as a decentralized digital currency, operating without central banks or governments, secured by cryptography and maintained by a distributed network of computers. The vision was revolutionary. Money that couldn't be controlled, inflated or seized by authorities, money that could be transferred globally without intermediaries, money secured by mathematics rather than trust in institutions. In its early years, Bitcoin was a curiosity worth pennies, used mainly by technology enthusiasts and those conducting transactions they preferred to keep private. But gradually it gained value and attention. By 2017, it had reached nearly $20,000 per coin before crashing. By 2021, it exceeded $60,000 before falling again. The volatility has been extraordinary, far exceeding even the most volatile stocks. The question for diversification purposes is whether cryptocurrency provides genuine portfolio benefits through low correlation with traditional assets. The evidence is mixed and evolving. In theory, Bitcoin should be uncorrelated with stocks and bonds. It operates on different principles, responds to different forces. Stock markets are driven by corporate earnings and economic growth. Bitcoin's price is driven by adoption, speculation, regulatory developments, technological advances, and the broader crypto ecosystem. In practice, correlation has been inconsistent. During some periods, Bitcoin has moved independently of traditional markets, rising while stocks fall or falling while stocks rise. This negative or zero correlation is exactly what you want for diversification. If Bitcoin zigs when stocks zag, holding both reduces overall portfolio volatility. But during market stress, particularly in 2020 when the COVID pandemic initially struck, Bitcoin fell along with stocks. Risk assets of all kinds sold off simultaneously as investors fled to cash and government bonds. The correlation that was low or negative during calm periods became positive during crisis, exactly when you most need diversification to work. This pattern isn't unique to cryptocurrency. Many assets that appear uncorrelated during normal times become correlated during crises because fear drives all risky assets down together. Real estate, commodities, stocks from different countries, they all tend to fall together when panic sets in. Only the safest assets like US Treasury bonds and cash reliably hold value or rise during true market crashes. So the diversification benefit of cryptocurrency is real but limited. It adds another source of return, another type of asset with different characteristics. But it's not a perfect hedge, not a guarantee of protection during downturns. And the extreme volatility means that even a small allocation can create significant portfolio swings. Many financial advisors who've come to accept cryptocurrency in portfolios suggest keeping allocations modest, perhaps 1 to 5% of total portfolio value. At that level, if cryptocurrency soars, you participate meaningfully in the gains. If it crashes, the damage to your overall portfolio is limited. You've captured some diversification benefit without taking outsized risk. The philosophical question around Bitcoin is whether it's digital gold, a store of value that will retain purchasing power over time, or whether it's speculative mania, a bubble that will eventually pop completely. Proponents argue that Bitcoin's fixed supply, only 21 million coins will ever exist, makes it superior to fiat currencies that governments can print endlessly. They see it as protection against inflation and monetary debasement, a digital version of gold's historical role. Skeptics point out that Bitcoin has no intrinsic value, generates no cash flow, serves no industrial purpose. Its value is entirely based on belief, on the shared conviction that it's valuable. Unlike gold, which has been valued for thousands of years and has actual uses in jewelry and electronics, Bitcoin's value could theoretically fall to zero if confidence evaporates. Both perspectives contain truth. Bitcoin has characteristics that could make it valuable as a store of value and medium of exchange. But it also has characteristics of speculative bubbles. Perhaps it will mature into a genuine alternative currency or digital gold. Perhaps it will prove to be this generation's tulip mania. Time will tell. From a diversification standpoint, what matters is that cryptocurrency behaves differently from traditional assets, at least during non-crisis periods. Whether Bitcoin eventually succeeds or fails, whether its current price is justified or absurd, is almost beside the point. The question is whether holding some provides portfolio benefits that outweigh the risks and volatility. For risk-tolerant investors with long-time horizons, a modest allocation might be appropriate. For conservative investors or those with short-time horizons, it probably isn't. Beyond Bitcoin, the cryptocurrency world has exploded into thousands of different tokens and coins, many with specialized purposes. Ethereum enables smart contracts and decentralized applications. Stablecoins attempt to maintain fixed values relative to dollars or other currencies. Tokens represent everything from governance rights in decentralized organizations to digital art ownership to gaming assets. This entire ecosystem is sometimes called crypto or digital assets, or blockchain-based assets. Some of these have potential utility and value. Most will likely fail, proving to be worthless speculations. Distinguishing between them requires technical knowledge and risk tolerance that most investors lack. For diversification purposes, if you're going to have cryptocurrency exposure, Bitcoin and perhaps Ethereum are the most established, most liquid, least likely to completely disappear. The smaller, newer tokens are more speculation than diversification. Non-fungible tokens, or NFTs, represent another digital frontier. These are unique digital assets, art, collectibles, virtual real estate, whatever, secured by blockchain technology. Each NFT is distinct. Unlike fungible assets like Bitcoin, where every coin is identical and interchangeable, the NFT market exploded in 2021, with digital artwork selling for millions of dollars, then largely collapsed in subsequent years. NFTs are not serious diversification tools for most investors. They're more like art or collectibles. If you enjoy them, if you're participating in digital culture, if you have money you can afford to lose, then perhaps they're interesting. But as portfolio diversifiers, they're too new, too volatile, too illiquid, too speculative. They might eventually mature into a legitimate alternative asset class. For now, they're more curiosity than investment strategy. The broader question these new digital assets raise is how to evaluate emerging asset classes for diversification purposes. What criteria should you use? How do you decide whether something new belongs in your portfolio? Start with correlation. Does the new asset class move independently of what you already own? If it's perfectly correlated with existing holdings, it adds nothing. If correlation is low or negative, it might add diversification value. But remember that correlations can change, especially during crises. Historical correlation during calm periods isn't a guarantee of future correlation during stress. Consider liquidity. Can you sell the asset quickly if needed? Stocks and bonds are highly liquid. You can sell any time markets are open and receive cash in days. Real estate is illiquid. Selling takes months. Cryptocurrency is moderately liquid. You can sell on exchanges 24 hours a day, though prices can be volatile and spreads wide. NFTs and some crypto tokens are highly illiquid. Finding buyers at fair prices can be difficult or impossible. Evaluate fundamentals. Does the asset produce income or cash flow? Stocks generate dividends from earnings. Bonds pay interest. Real estate produces rent. These cash flows provide intrinsic value independent of price speculation. Bitcoin and most cryptocurrencies generate no cash flow. Their value depends entirely on price appreciation, on finding someone who'll pay more tomorrow than you paid today. This doesn't make them worthless, but it does make valuation much more uncertain. Assess volatility. How much does the asset's price swing? Higher volatility requires higher expected returns to be worth including in a portfolio. Cryptocurrency's extreme volatility, 50% swings in weeks or months, means it needs extraordinary long-term return potential to justify the ride. For many investors, the psychological toll of watching their crypto holdings swing wildly outweighs any diversification benefit. Consider regulatory and technological risk. Cryptocurrencies face uncertain regulatory futures. Governments might ban them, restrict them, or embrace them. Technological risks exist too. Flaws in code, hacking, better technologies displacing current ones. Traditional assets have regulatory frameworks and technological infrastructure that are well established. Emerging assets operate in murkier territory. Think about your own knowledge and understanding. Can you explain how the asset works, why it has value, what drives its price? If not, you probably shouldn't be investing significant money in it. Mystery is not a sound basis for investment. Bitcoin's technology and economics are complex but understandable with effort. Many crypto tokens are opaque even to experts. Invest only in what you can comprehend. The reality is that most investors don't need exposure to cutting-edge emerging assets. A portfolio of traditional stocks, bonds, and real estate provides robust diversification, and has proven itself across decades of varied market conditions. Adding cryptocurrency might provide marginal additional diversification, but it's not necessary for success. If you're curious about cryptocurrency, if you have risk tolerance and long-time horizon, if you understand the technology and accept the volatility, then a small allocation might be appropriate. Perhaps 1 to 5% of your portfolio, money you can truly afford to lose entirely without derailing your financial plans. Treat it as a speculative position that might pay off handsomely or might go to zero, not as a core portfolio holding. But if cryptocurrency feels too risky, too volatile, too complicated, or simply unnecessary, there's no requirement to hold it. You can build a perfectly good, well-diversified portfolio without any crypto exposure whatsoever. Don't let fear of missing out drive you into investments you don't understand or aren't comfortable with. Missing out on Bitcoin's gains is preferable to losing money you can't afford to lose in its crashes. The deeper lesson from cryptocurrency's emergence is that financial innovation creates new possibilities but doesn't invalidate fundamental principles. Diversification remains wise. Avoiding concentration remains prudent. Understanding what you own remains essential. Managing risk remains crucial. The specific assets available change over time, but the wisdom underlying portfolio construction persists. Think about how investors in the 1950s would have approached emerging assets of their time. Real estate investment trusts didn't exist yet. Index funds hadn't been invented. International investing was difficult and rare. Commodities futures were exotic instruments most people never touched. Each of these eventually became standard components of diversified portfolios, but they were new and strange when they first appeared. The investors who evaluated these innovations through the lens of diversification principles, does this add uncorrelated returns? Do I understand it? Is the risk appropriate for potential reward? Made better decisions than those who either rejected all innovation as dangerous or embraced everything new as revolutionary. The thoughtful middle path of evaluating innovations against timeless principles served them well. You can take the same approach with cryptocurrency and whatever financial innovations emerge next. Don't reject them reflexively because they're new and different, but don't embrace them uncritically because they're exciting and everyone's talking about them. Evaluate them calmly against criteria that have served investors well for generations. As you rest here now, as sleep draws ever closer, let this contemporary perspective settle alongside the historical wisdom we've explored. The world of investing evolves, new assets emerge, technology creates possibilities that didn't exist before, but human nature remains constant. Fear and greed, caution and speculation, wisdom and folly, these dance through every era, wearing different costumes but following the same choreography. Cryptocurrency might be the digital gold its proponents claim. It might be a speculative bubble that eventually pops. More likely, it's something in between, a genuine innovation with real use cases and value, but also prone to speculation and volatility, suitable for some investors in modest allocations, but not a revolutionary replacement for traditional diversification. The future will bring other innovations, other new asset classes we can't yet imagine. Some will prove valuable additions to diversified portfolios. Others will prove to be distractions or disasters. The investors who thrive will be those who evaluate these innovations thoughtfully, who maintain discipline grounded in proven principles, who don't abandon wisdom in pursuit of novelty, but also don't close their minds to genuine innovation. You can be one of those investors. You can remain curious about new developments while maintaining skepticism. You can experiment with small allocations to emerging assets while keeping the core portfolio grounded in proven diversifiers. You can embrace the future while respecting the past. This balance, this wisdom, this integration of old and new, this is how wealth is protected across generations despite constant change. We've explored how diversification applies to the newest frontiers of investing, how emerging assets like cryptocurrency challenge us to evaluate innovation through the lens of timeless principles. Now let's expand our view beyond financial portfolios entirely, beyond stocks and bonds and digital assets, to consider how the wisdom of diversification illuminates life itself. Let your body sink deeper into rest. Feel the softness beneath you, the gentle pull of sleep. We're moving now from money to meaning, from investments to existence, discovering that the simple rule that protects wealth also protects well-being, security, resilience across every dimension of human life. The principle is the same whether we're talking about portfolios or careers or relationships or skills. Don't put all your eggs in one basket. Spread risk. Create multiple pathways to success. Build redundancy and resilience. These aren't just financial strategies. They're life strategies, tested across human experience, proven through countless examples of those who thrived because they diversified and those who struggled because they concentrated. Let's begin with human capital, because for most people, especially younger people still building wealth, their human capital, their ability to work and earn income, is their most valuable asset. Your skills, knowledge, experience, credentials, relationships, reputation, these constitute human capital, and they deserve the same thoughtful diversification we apply to financial capital. Think about someone whose entire skill set is concentrated in a single industry, a single type of work. Perhaps they're a specialist in a particular manufacturing process, or an expert in a specific software platform, or deeply knowledgeable about regulations in one industry. If that industry thrives, they thrive. They're well compensated, in demand, secure. Their concentration appears to be paying off, but industries change, technologies become obsolete, regulations shift. What was valuable becomes worthless, sometimes slowly across decades, sometimes shockingly fast. The coal miner whose skills were valuable for 20 years finds those skills irrelevant as coal declines. The bookkeeper who mastered manual accounting discovers computers have eliminated the need for their expertise. The travel agent whose knowledge of airlines and hotels discovers the internet has disintermediated their profession. These aren't failures of character or effort. These are failures of diversification. Skills concentrated in a single domain, no matter how valuable that domain seems today, create vulnerability tomorrow. The diversified alternative is to develop multiple competencies, multiple skill sets that apply across different contexts and industries. Perhaps you're an engineer, but you've also developed project management skills, communication abilities, understanding of business finance. If engineering opportunities in your specific field decline, you can pivot to program management, technical writing, business analysis, consulting. You've diversified your human capital across related but distinct skill sets, creating resilience against any single path closing. The concept of a portfolio career captures this idea beautifully. Rather than a single linear career path, a portfolio career involves multiple simultaneous or sequential roles, multiple income streams, multiple professional identities. You might be a part-time consultant, a part-time teacher, a part-time writer. You might have a main job but also side projects that could become primary income sources if needed. You're diversified across different types of work, different employers or clients, different income streams. This diversification protects you from dependency on any single employer or client. If your main job disappears, you have other income sources to fall back on. If one client stops needing your services, others continue. You've eliminated the single point of failure that traditional employment creates, where losing one job means losing all income simultaneously. The gig economy and remote work have made portfolio careers more feasible than ever before. You can freelance for multiple clients across different geographies. You can combine employment with entrepreneurship. You can develop passive income streams through digital products, investments, rental properties while maintaining active employment. The tools and platforms exist to diversify your income in ways that previous generations couldn't easily access. But income stream diversification requires deliberate effort. It means saying no to maximizing income from your primary source in favor of developing secondary sources. It means investing time in building skills and relationships outside your main job. It means accepting short-term opportunity costs for long-term resilience. This is exactly parallel to financial diversification, accepting slightly lower returns to reduce risk. Geographic flexibility represents another form of career diversification. If your skills and work can be done remotely from anywhere, you're not dependent on a single local job market. If your city's economy declines, you can work for employers elsewhere without relocating. If you can relocate easily without sacrificing career progress, you have options others lack. Geographic flexibility is career diversification across location, reducing dependence on any single place's economic health. Skills diversification extends beyond professional competencies to practical abilities. Can you repair things, grow food, cook, manage basic home maintenance, provide first aid? These practical skills create self-sufficiency that reduces dependence on markets and services. They're a form of insurance, capabilities that retain value even when economic systems struggle. During the 2008 financial crisis, people who could maintain their own cars, repair their own homes, grow some of their own food, had lower expenses and greater resilience than those who depended entirely on purchasing every service. During the COVID pandemic, those who could cut their own hair, bake their own bread, entertain themselves without relying on businesses that were closed faced less disruption. Practical skills are diversification against service dependencies. Educational diversification matters too. The person with narrow specialized education is vulnerable to their specialty becoming obsolete. The person with broad education, technical skills plus liberal arts, depth in one area plus breadth across many, has more adaptability. They can understand new context, learn new domains, apply knowledge across boundaries. They've diversified their intellectual capital. This isn't an argument against specialization. Depth of expertise creates value, but pure specialization without breadth creates fragility. The ideal is T-shaped knowledge, deep in one area, broad across many, deep enough to be excellent at something, broad enough to connect domains, learn new things, pivot when necessary, specialized and diversified simultaneously. Relationship diversification is delicate territory because relationships aren't fungible like investments. Each relationship is unique, irreplaceable, valuable for its own sake. But the principle still applies. Depending entirely on one person for all emotional support, social connection, practical help, and intellectual stimulation creates vulnerability. Not because that person might betray you, but because people move, circumstances change, relationships end for reasons beyond anyone's control. A diversified social network includes friends, family, colleagues, community members, people from different contexts and stages of life. When you're struggling, you have multiple people you might turn to. When you need help, multiple potential sources. When you want connection, multiple options. This isn't about using people instrumentally. It's about recognizing that rich, varied social connections create resilience that isolation or overdependence on any single relationship cannot provide. Professional networks deserve deliberate cultivation. The person whose entire network is within their current employer is vulnerable if they lose that job. They're starting from zero in building connections at a new company. But the person who has maintained relationships across multiple employers, industries, and contexts has a network that survives any single job loss. They can reach out for opportunities, advice, introductions. They've diversified their social capital across different professional communities. Health is perhaps the ultimate non-diversifiable asset. You have one body, one life. When it comes to physical and mental health, diversification means something different, not spreading risk across multiple bodies, obviously impossible, but maintaining multiple dimensions of health and multiple protective factors. Physical health involves cardiovascular fitness, strength, flexibility, nutrition, sleep, stress management. Neglecting any dimension creates vulnerability. The person who only does cardio has poor flexibility and weak bones. The person who only lifts weights might have cardiovascular weakness. The person who exercises but eats poorly or sleeps poorly undermines their health through other channels. Diversification across health dimensions creates more robust well-being than excellence in any single dimension. Mental health diversification means having multiple sources of meaning, purpose, joy, and coping strategies. If your entire sense of identity and worth comes from work, losing your job threatens your psychological foundation. If you have multiple sources of meaning, family, friendships, hobbies, creative pursuits, spiritual practices, community involvement, the loss of any single source, while painful, doesn't destroy you. You've diversified your psychological portfolio. Coping strategies benefit from diversification too. The person who manages stress only through exercise is vulnerable when injury prevents exercise. The person who copes only through social connection struggles during isolation. Having multiple healthy coping mechanisms, exercise, meditation, creative expression, social support, nature, therapy, spiritual practices, creates resilience. When one isn't available or isn't working, others remain. The entrepreneur building a business faces classic diversification dilemmas. Should you focus all energy on one venture until it succeeds or fails? Or should you hedge by running multiple smaller ventures simultaneously? There's no universal answer, but understanding the trade-offs helps. A single focused venture can receive undivided attention, maximum resources, the kind of commitment that often proves necessary for success. Many successful entrepreneurs concentrated everything on one business, refusing to diversify until that business succeeded. Steve Jobs focused on Apple. Elon Musk concentrated on Tesla and SpaceX despite enormous risk. Concentration enabled the success. But for every successful concentrated bet, countless others failed catastrophically. The entrepreneur who put everything into one business and watched it collapse lost everything. They didn't have other ventures to fall back on, other income to sustain them, other options to pursue. Concentration created the possibility of spectacular success, but also the reality of spectacular failure. Serial entrepreneurship, starting one business, building it to stability or exit, then starting another, is diversification across time. You're not spreading resources across simultaneous ventures, but you're not putting your entire career into a single bet either. If one venture fails, you start another. You've diversified your entrepreneurial capital across multiple attempts. The entrepreneur with a day job maintaining income while building a business on the side is diversifying across employment and entrepreneurship. Lower potential upside, they can't devote full time to the business, but also lower risk. If the business fails, they haven't lost their income. They can try again. The entrepreneur with multiple small ventures simultaneously is diversifying across different businesses. If one fails, others might succeed. But divided attention might mean none receive enough focus to truly thrive. It's the classic diversification trade-off. Lower risk, possibly lower returns. The right choice depends on risk tolerance, financial situation, family obligations, and countless personal factors. But understanding that it's a diversification decision, subject to the same principles we've explored throughout this journey, provides clarity. You're choosing between concentrated risk and reward versus distributed risk and reward. Neither is inherently right or wrong. Both are valid strategies depending on circumstances. Financial independence itself is a form of diversification away from employment dependency. When you've built sufficient wealth to live without working, you've diversified your income away from requiring employment. You can work if you choose, but you're not dependent on it. This is the ultimate career diversification, creating the option not to have a career at all. Passive income streams work toward this same goal. Rental income from properties, dividends from stocks, interest from bonds, royalties from creative work, income from businesses that don't require your active involvement. Each represents income independent of your labour. You've diversified away from depending entirely on trading time for money. This doesn't mean everyone should pursue financial independence or passive income. These are goals, not requirements. But understanding them as diversification strategies helps frame decisions. Every dollar of passive income is a dollar of reduced dependency on active income. Every month of expenses covered by investment income is a month of increased freedom and reduced vulnerability. The life lived with deliberate diversification looks different from the life of concentrated focus. It might involve multiple interests rather than singular passion, multiple modest successes rather than one, spectacular achievement, resilience and stability rather than boom or bust. There's no moral superiority to either approach. They're different philosophies, different risk profiles, different paths through uncertainty. But as you drift towards sleep now, as these ideas about life diversification settle gently into your consciousness, consider whether the wisdom that protects financial wealth might also protect the broader wealth of a life well lived. Consider whether spreading your bets across skills and relationships and income sources and sources of meaning creates a richer, more resilient existence than putting everything into any single basket. The simple rule that protects millionaires, diversify, balance, avoid concentration, applies to careers and skills and relationships and health and sources of meaning. It applies because the underlying truth is mathematical and psychological, not merely financial. Systems with redundancy survive shocks better than systems with single points of failure. Leases with variety and balance weather storms better than lives dependent on any single source of security or satisfaction. You can apply this wisdom starting tomorrow, starting with small steps toward diversification in whichever dimensions feel most relevant or most vulnerable. You can develop a side skill, build a side income stream, deepen a neglected relationship, explore a new interest, create a backup plan for your backup plan. Each small diversification reduces your total vulnerability, increases your total resilience. Or you might choose concentration in certain areas, deliberately accepting the risk in exchange for the possibility of extraordinary returns. That's fine too. The point isn't that everyone must diversify everything. The point is understanding the trade-offs, making conscious choices, building the life you want with eyes open to both the benefits and costs of concentration versus diversification. Sleep peacefully in this expanded understanding. The principles we've explored across 8 acts of financial wisdom apply far beyond finance. They're principles of resilience, of wisdom, of navigating uncertainty with grace and forethought. Money is just one dimension of life where these principles prove valuable. But every dimension, career, health, relationships, meaning, security, benefits from the same thoughtful approach to balance and variety. Dream of lives that are rich in their diversity, that draw strength from multiple sources, that maintain resilience through deliberate redundancy, that survive shocks because no single failure can destroy the whole. Dream of the freedom that comes from not depending too heavily on any single thing, the security that comes from building multiple pathways to what you need and value. We've travelled far together tonight, from ancient merchant ships to modern cryptocurrency, from mathematical proofs to life philosophy, from the concentration that destroys wealth to the diversification that preserves it. And now, as our journey draws to its close, as sleep pulls you ever deeper into its embrace, let's rest in the simple, profound truth we've discovered. Diversification is wisdom, not complicated wisdom requiring expertise or wealth. Simple wisdom, accessible to all, proven across centuries and cultures. Don't put all your eggs in one basket. Spread your risk. Embrace balance. These words, so plain they sound almost trivial, contain within them the protection that has preserved fortunes through crashes and panics, that has sustained families through generations, that has allowed ordinary people to build security in an uncertain world. You understand now. You understand that 20 thoughtfully chosen stocks provide nearly all the protection that 200 would offer. You understand that stocks and bonds move differently, that their combination creates stability neither possesses alone. You understand that time itself diversifies through regular investment and patient rebalancing. You understand that the wealthy protect their fortunes through the same principles available to everyone, just expressed at different scales. And you understand that diversification extends beyond money into the very structure of a resilient life, multiple skills, multiple income sources, multiple relationships, multiple paths to meaning and security. Let this understanding rest gently in your mind as sleep claims you completely. There's nothing more you need to learn tonight, nothing more you need to remember. Just this: balance protects, variety strengthens, diversification endures. And so we've arrived at the end of our gentle journey through the wisdom of diversification, through the simple rule that has protected wealth across centuries and cultures, through the understanding that balance and variety create resilience that concentration can never achieve. Let yourself sink completely now. Let every muscle release. Let your breathing find its slowest, deepest rhythm. There's nowhere to go, nothing to do, no decisions to make tonight. You've walked with ancient merchants loading cargo across multiple ships. You've stood with Harry Markowitz as he revealed the mathematics underlying intuition. You've witnessed the tragedies of concentration and the quiet victories of balance. You've seen how the simple act of spreading risk across stocks and bonds, across time and geography, across skills and relationships, creates protection that compounds across the years of your life. This wisdom is yours now. Not complicated formulas or exclusive strategies, but timeless truth available to all. Don't put all your eggs in one basket. Build balance. Trust in variety. Let time work its patient magic. Sleep deeply in this knowledge. You're part of a long human story. Generations learning and relearning that resilience comes from spreading risk, that security emerges from thoughtful balance, that the path to preservation winds through diversification. Rest now. Dream peacefully. The simple rule that protects millionaires protects you too. Let go completely. Breathe. Sleep.